are going to open up with Tony Zhang telling us about openness, integration, and intentional monitoring.
Okay.
Take it away.
Good. Thank you, Şebnem. Thanks to the organizers. This has been fantastic conference so far. And yeah, I'm looking forward to the second day. This is work with Tarek, and who's over there, Thomas, who's not here, and Jingye, who's also over there. Because Thomas at the San Francisco Fed, the usual disclaimers apply. Okay. Here we go. Oof. All right. So as we've been talking about, in recent years, the dollar's role as the world's anchor currency has come into a little bit of question. And in particular, we discussed yesterday how there was tariffs of the April 2025. These announcements, they led to some pretty weird market reactions. Dollar depreciated even though measures of global risk increased. We saw U.S. interest rates rise and U.S. stock market fell relative to the rest of the world. And so that background is the motivation for this analysis that we're going to present today. In this paper, we're going to try to do two things. One is we're going to try to perhaps better understand some of the economic forces underpinning the dollar's role, specifically as the linchpin of global finance. All right. And the second thing we're going to try to do, is to try to understand whether or not we can have policy tools that influence these forces and how they're available to Europe. And under what conditions could the euro emerge as the world's anchor currency? To start off our analysis, for the next 4 slides or so, I'm going to present a model that forms as the background to our analysis, the backbone of our analysis. It's a pretty standard model of exchange rate determination, and I'll lead you through the intuition of how it works. Essentially, the static model, there's 2 periods, t equals 1 and 2. There's a unit mass of households, and they're going to be split into n different countries. Countries are going to differ by how large they are. So theta n measures is a measure of how large countries are, and the U.S. is going to be special because it's going to be the largest economy in the world. Households are going to invest in the first period and consume in the second period. There we go. They consume a consumption bundle C, where the C is a basket of traded and non-traded goods. How do the traded goods and non-traded goods come into play? The non-traded good will be produced. Households own firms that produce this non-traded good. It's an AK production function, so you have this ADA here, which is a productivity shock, as well as some capital that is installed. Each household is endowed with 1 unit of capital initially. It's freely shipped around in the first period, invested, installed, and it's used in production of the non-traded good. Traded goods. They are endowed, and they are homogeneous across all households, all countries. They're freely shipped around at any time, and they serve as a numeraire in this economy. So the state of the economy can be described in the second period by 2 shocks. One is this productivity shock that we showed on the previous slide, used in the production of the non-traded good. The other is a monetary shock, mu. You can think about this as a kind of inflation shock. How does it work? Households in each country, they're going to be split into 2 portions. There's the financiers with a measure psi, and consumers with a measure 1 minus psi. The consumers basically give all their wealth in the first period. They take all their wealth and give it to the financiers. The financiers take that wealth, they invest it into stocks and bonds, and in the second period, they're going to give some of that wealth back to the consumers. They're going to pay them a nominal bond, and the nominal bond payoff is PN times this monetary shock. And so if you look at it closely, what you see is that if mu is very low, we interpret that as a low inflationary state, then the nominal bond payoff in real terms will be large. Okay? And so what that means is that this monetary shock redistributes wealth between consumers and financiers. And this is basically the same as having a demand shock. If the monetary shock is low, the inflation is low, the consumers are going to get a large payoff, and they're going to be able to consume more. They have higher demand. Okay. Households and firms are price takers. Markets are going to clear. These are the usual market clearing conditions for capital, traded goods, and non-traded goods. How do we solve the model? Well, to first order, so we just set up the social planners problem, take first order conditions, log linearize. Okay, the pretty standard stuff. What's the mechanism of exchange rate determination in our model? This is basically the important result here. Like most models of exchange rate determination that kind of follow the setup, what happens is that a currency of a country N, for example, is going to appreciate whenever local demand exceeds local supply. Okay. So how can that happen? It can happen if the productivity shock is particularly low and you have a low production of non-traded good, or if inflation surprises are low, the consumers are really rich and they want to consume a lot of goods. When you have this appreciation, in the states of the world, when you have this appreciation of your currency, you're also going to consume more traded goods, right? You want to consume, so where do you get these extra goods from? You're going to import them from the rest of the world. And so you can see here with your consumption of traded goods, if your production of non-traded goods is below average, or if your inflation is below average, you're going to import more goods. For notation purposes, this YM bar, this is the average shock that's hitting the world. Okay. However, because countries differ by size, the shocks of different countries are going to have different effects on the world price of traded goods. And the world price of traded goods also is going to serve as the stochastic discount factor to price assets in this economy. In particular, if you're the US, you're the largest country. If you have, say, a low inflation shock and your households are feeling particularly rich, so they're going to import more of the world's traded goods, well, because of how large the U.S. is, that's going to spill over more to the rest of the world, and that's going to drive the world price of traded goods up more. Okay, and so you can see that the impact of each country's shocks on the world price of traded goods is going to be determined by how large they are. Large countries have a larger impact. If you're a small country like Denmark and you have a high demand shock, that's great. You're gonna import some more traded goods, but because you're small, you have a pretty small effect on the world price of traded goods. What this mechanism does is it drives a strong covariance between the world price of traded goods and also the SDF with the exchange rate of the large countries in the world. In other words, the US dollar will appreciate whenever traded goods are expensive. Other currencies, less so. And so that underpins the asset pricing properties of this economy. The dollar ends up becoming the safest currency in the world because the US is large. Its currency has the highest covariance with the stochastic discount factor. And in particular, safety increases pretty generally with country size. As a result, larger economies are going to have lower interest rates. People are going to want to hold the dollar because it appreciates it precisely in those states of the world where the marginal utility from consumption is really high. And as a result, this also translates into higher values for US firms, and US firms are going to get more international investment. Why? It's the same logic. It's the dividends from these US firms are going to pay off in dollars, and dollars are going to be worth a lot because they hedge against consumption risk. Okay, so that serves as like kind of the baseline model. In a follow-up paper that we had in the 2023 in the restud, we asked, well, you have these large countries that have these safety properties to their currencies. Can smaller countries implement some policy to gain some of those, some of the nice properties that these large countries have? Can they gain can they do something to also make their currencies a little bit more safe? And we thought about this through the lens of exchange rate stabilization. So suppose you have a country M, and it gets two things to do now. It can choose a target to stabilize its exchange rate to, and it can also choose the degree of exchange rate stabilization. You can represent it here by this equation. So it makes its own exchange rate relative to some target country. It's going to shrink that volatility by some factor omega. If it shrinks that volatility all the way down to 0, that's like a hard peg. If it doesn't shrink its policy at all, that's like floating. Well, in this earlier paper, we show that there's both positive implications as well as normative implications. The positive implications are that if you do stabilize your currency to an appropriate large target currency, you do import some of those risk properties, the safety properties of that larger currency. And that leads you to have lower interest rates and higher firm values, and it will attract capital investment from abroad. How does this work? You know, the same, if you think like Denmark, Denmark is a small country, it's Danish kroner, suppose it moves up and down freely, well, if it makes the krona move up and down exactly in line with the US dollar, then from the international investor perspective, there's no difference between the krona and the US dollar, and so I will be willing to hold more krona, I will be willing to invest more in Denmark. However, there's also normative implication. There's a cost to doing this. And as particularly, the cost is you're going to have to trade on world markets. And as the larger the country is, the more costly it's going to be to try to influence its exchange rate, because you're going to have to kind of work against, or potentially work against all the demand that's coming from your home, from the residents of your home country. And so for large countries, this ends up becoming a costly intervention. It's cheap for small countries. And so what you get out of this is that you can get the dollar-centric system that you observe in the world kind of endogenously. Whereas small countries, they're going to want to stabilize their exchange rate fully. Medium-sized countries will kind of want to have a loose stabilization, and the largest countries are going to want to float. But importantly, all the countries, they're going to want to stabilize to one currency in particular, and that's the currency of the largest economy. And so that's a quick summary of that paper. Having this, theoretical background, we're going to try to operationalize this in a quantitative sense. And so in this paper today, we're going to calibrate our model to a 1984 to 2019 period, this period where world markets are relatively free, because we want to ultimately derive implications for how, what kind of policies Europe might want to adopt to promote the euro as an anchor currency. All right, so we start off by calibrating the model to do two things. We're going to try to match differences in interest rates across countries. So we're going to try to match a set of asset pricing moments. At the same time, we're going to try to match the world monetary order as it currently stands. So we're going to have an economy where it's optimal for small economies to stabilize heavily, so almost going to a hard peg. Medium-sized economies to stabilize a little bit less, and large economies are going to want to freely float. In the quantitative, and we're going to do some quantitative exercises later where we use, the state of the world as it currently is in terms of country size, and we'll get to that soon. And so the first result is, again, having this framework that I just described, we can basically match the current status of the world monetary order as it is. On the bottom here, on the x-axis, I'm plotting the sizes of the various economies in the world, binned into three buckets: small countries, medium-sized countries, and large countries. On the x-axis, I'm showing you how much do these countries in their currency stabilize to the US dollar. And what you see is that this line here is what's implied by our model as an optimal stabilization. The dots here are the data. And you indeed see that small countries, they stabilize quite a bit. Medium-sized countries stabilize a little bit less. And large countries, they're going to freely float. Exactly as our model endogenously, our model would describe. And so, as I mentioned before, with this framework, this dollar-centric system emerges from, endogenously, from individual optimality choices. All right, I have to go through one more piece of work that we did earlier this year, which is that how do we now tie it to modern day? In recent times, we have seen a rise of tariff policies, and in particular, you want to think back to April 2025. All right. What we got out of our framework is that the safety properties and the anchor currency properties of a currency are effectively determined by how large a country is. So what happens then if you see a country like the US impose tariffs on imports? Well, we do this formally within our framework by inserting a wedge between the home and world prices of traded goods. And essentially, before what I said was, a shock hitting the US, it spills over a lot to the rest of the world through the US consumption of traded goods. The US is going to, when the US has a low inflation shock, households in the US, they consume a lot, and so they're going to buy up a lot of the world's traded goods, and the world market price of traded goods goes up. When you insert a tariff, that is dependent on how much the US consumes from the rest of the world. So you're taxing imports. Essentially, every shock on the US is now going to spill over to the rest of the world less. That makes the US systematically less important to the rest of the world. All right? It dampens the effect of US shocks on the world market. And from this country size perspective, basically having this trade world reduces the US's effective country size. As a result, the US dollar becomes less covaried, it covaries less with the world market price of traded goods. And from the view of an international investor, the dollar then becomes less safe. And then decreases the incentives for the rest of the world to stabilize the US dollar. Okay, so those are the economics that pin down the next set of analyses I'm going to do for the Europe in particular. In this next set of in our paper, we're going to think about 3 policy levers Europe can try to do to try to promote the euro as an international currency, or think about ways in which the euro can become more prominent as an international anchor currency. The first one, and we're also going to talk about these policies in the order that they're kind of in Europe's control. All right. So the first one is directly in European control, which is about integration. All right. As of today, Europe, the eurozone comprises about 15% of world GDP. And there's really 2 ways we can think about integration in the euro area. One is real integration, and one is just promoting the adoption of the euro across more countries. What do I mean by real integration? Well, you have different countries right now with different supply shocks and the like, and some are correlated, some might be non-correlated. So within our framework, we're going to try to think about, let's take all the eurozone countries and let's make all their supply shocks perfectly correlated with each other, so that you can consider them kind of as one country as a whole. Euro adoption, that's a bit that's pretty more straightforward. It's like, suppose you have more countries now and you expand your monetary shock to cover a broader set of countries. And which countries are you going to think about? All right, so first you can think about first we're going to think about what happens if you just take the current set of eurozone countries and you just make all the real shocks perfectly correlated. That's this deepening EU integration bar right here. You can see that you can raise the size of the eurozone from 15% to about 17%. You can then think, what if you enlarge the EU? All right, there's a set of countries out there that both are willing to join the EU, or perhaps were a part of the EU and like the UK and disappeared, but then perhaps maybe they want to come back. All right, so you just expand the size of the European Union and you try to integrate those countries as well. And you can see that potentially can now increase the size of the Eurozone up to 0.22. And then what if you expand the euro even more to all of these countries? You can maybe expand the Eurozone up to 24% of world GDP. Okay, so these are 3 different levels of Eurozone integration that are potentially there. 2 things to point out. This by itself alone still does not make the Eurozone as large as the US. So by itself, it's not quite there yet. That's point 1. The second thing is that a lot of the gains from this integration is really coming from the real side. Expanding the monetary shocks to the euro to more countries is not necessarily the easiest way to expand the size of the eurozone. What really matters seems to be that you want to try to make shocks more correlated across countries. So perhaps from the fiscal side. How do you get the euro to overtake the dollar? Well, part of this is now coming from the US side. In the US, we do have tariffs. And these tariffs are doing quite a bit to reduce the effective size of the US. What I'm showing here is a plot of, within our framework, of how safe a currency is, how correlated is a currency with the world market price of traded goods, on the y-axis plotted against the size of the tariffs that the US is imposing. All right. And what you can see here is that if you look at this thick black line, is that as the US imposes more and more tariffs, its currency is being viewed as less and less safe. US tariffs erode dollar safety. And as long as the Eurozone stays open, the euro is going to gain in safety as a consequence of that. As the Eurozone currently stands, the euro will our model forecast predicts that basically the euro overtakes the dollar if US tariffs hit something like 26%. Right? That's at the current Eurozone state. However, if you go back to the previous slide and you think about the EU becoming larger, integrating more economies in the region, if we think about the EU enlargement scenario where the Eurozone starts incorporating all the other countries that have potentially expressed interest in joining the euro, then even at a 6% tariff, the euro overtakes the US as the most dominant anchor currency in the world. Okay, so a combination of having a larger euro plus the tariffs that are existing can drive the euro into becoming the most safe currency and can really incentivize other current countries to stabilize relative to the euro. This plot basically shows the same thing, but now from a welfare standpoint. So on the x-axis, we're taking the view of a small stabilizing country, and we're again plotting against the US tariff. You can see that floating for small countries, this dark black line is the how optimal is it to float your exchange rate. The stabilizing relative to the dollar, those incentives decrease as the U.S. imposes larger and larger tariffs, and so at some point you will want to switch over to stabilizing to the euro. And particularly, as long as the larger the Eurozone can make itself, the more those incentives are to stabilize to the euro, and this crossing over point becomes closer and closer to reality. Okay. Yes, in the interest of time, this kind of shows the same point in the same analysis. So I'm gonna move on. I will say that one more thing that I want to point out is that our analysis not only matters for the structure of the world monetary system, but they have pretty large fiscal effects as well. As we stated, when you become the world anchor currencies, if you're large enough to become the world anchor currency, your currency is viewed as safe and you're attracting international investment, your interest rates are going to decline. All right? And so one point of analysis we can show is that basically, given the change in if you are the US, you are now imposing these tariffs. As a result, your currency is less attractive to the rest of the world and your interest rates go up. That has large effects on the fiscal side. We basically take the US debt outstanding, and if you increase the servicing costs, the interest rate on that debt by say 42 basis points, which is what's given by our analysis, that increases the annual interest bill by over $100 billion, $150 billion. For the Eurozone, as long as the Eurozone stays open, it's benefiting a little from the fact that the dollar is less attractive, and so countries are going to want to invest more in the Eurozone, and that lowers interest rates a little bit. That also lowers annual interest bills by a small amount. But if the Eurozone can enlarge and it can potentially take over the anchor currency status, that's going to lower the interest bill even more, up to 100 billion euros per year. And so this is coming from the safety premium channel that we've talked about, and so these effects we think are quite large. Okay. Perfect. All right. There's two caveats that we want to mention now in the last 5 minutes. First, all of this analysis hinges on the fact that the Eurozone needs to stay open. Okay. A common thing that we might think about is, Europe and America were friendly for the most part, and so suppose the Euro area and the U.S. teamed up and formed a transatlantic bloc where there was free trade within this bloc, but then we impose tariffs on the rest of the world. The problem is that if you impose common external tariffs, you're effectively shielding the rest of the world, so any country that's not part of the U.S. or the Euro area, from shocks that happen in this trade bloc. And so as a whole, this trade block becomes less important for the rest of the world, for world market price of traded good. And as a whole, both the US and the Eurozone are going to look less attractive as investment opportunities. So both currencies will lose safety. At 12% common tariff, which is what the tariff rates are in the US, you can see that interest rates are going to rise in both countries by like 20 to 30 basis points. And in particular, that opens the door now for third countries. And in this last bit, I'm going to talk a little bit about China. We haven't talked at all about China, and we keep talking about country size, and China is the second largest economy in the world. Why don't we talk about China? And the answer is in particular is about capital controls. Okay. How do we think about capital controls within our framework? Essentially, the big picture is that capital controls basically behave like tariffs, but coming from the financial side. We all learned that when you have cross-border portfolio flows, they are the tools that finance trade flows. The capital account is the opposite of the current account, right? And so, formally, the way we model it in our framework is that capital controls are kind of like a cap on the current account. Whatever amount of traded goods that you would like to import, if you're imposing capital controls, you're essentially shrinking the amount of traded goods that you're able to import by some factor. All right, and so we formally introduced this restriction in our framework to think about China, and we say that suppose Chinese imposes capital controls, essentially what they do is they're shrinking the amount of traded goods that they can import by some factor kappa. And if there's a fully closed capital account, then trade has to be balanced. You can't import or export at all. And so what you essentially see from this setup is that each capital control can be equivalent to some sort of tariff on Chinese imports and exports. And as a result, capital controls will shrink China's effective size exactly as tariffs would. And in particular, what we're showing here is that if we plot the effective size of China, how large China is, relative to some level of capital controls, very quickly, that's going to disqualify China as an anchor currency because the size of China is going to drop quite dramatically. The importance of China for the global economy drops quite quickly. At a fully open capital account, the effective size GDP share of China is at 17%, which is represented by this dot here. But as China increases capital controls, you can see this drop off. How do you properly calibrate this? It's a little bit more tricky because you have to operationalize. You have to try to measure capital controls. One way of thinking about this is this Chin-Ito index, which kind of tries to go around and tries to think about what types of capital controls are being implemented in various countries. And just to give out some numbers, the U.S. and Eurozone in this data set, they're at 1, meaning that they're freely open, whereas China is pretty close to the opposite end, meaning it's quite closed. So in our last bit of analysis, we thought, well, perhaps this forms as a risk. And yes, the Chinese, essentially China opening up its capital account can serve kind of as a risk to the euro or the dollar as an anchor currency. So we thought, well, if we think of a little bit ahead in the world and China continues on its path of growth, and suppose it finally overtook the US, it's now 30% of world GDP, and it also decides to fully open its economy, in that state of the world, then the renminbi can end up becoming the anchor currency. Okay. Is there anything that the rest of the world can do? One potential outcome is if somehow the US, the euro, and they included all the other countries in the world outside of China to somehow team together and implement tariffs on China, that kind of block out China from the rest of the world, then some level of tariffs will then recover the US dollar as a world anchor currency. So by blocking if it somehow implements a global tariff on China, that blocks out China, it weakens the renminbi anchor, and it restores the dollar. But those are the conditions. In that case, though, however, the euro will then still remain as a secondary anchor currency. Okay, I'm essentially out of time. So let me talk. This was a lot. So let me try to recap what's happening here. Essentially, we thought about this analysis kind of as a policy roadmap for the euro. We started off by presenting this like risk-based view of anchor currency status, and it's really grounded in two things. One is how large a country is, the size, and then also how open the economy is, because you need to be able to influence world prices of traded goods. You need to influence the rest of the world. And so there's three different policy levers that we thought about that can affect the effective size of the euro. And we presented them in order of European control. One is just integration and enlargement. Can you get other countries to sign up together, to join together with the rest of the euro area? That may be good enough on its own to promote the euro as an anchor currency, given the current state of the US imposing tariffs on the rest of the world and the fact that China imposes capital controls. The second is being trade openness. It's important that the euro area remains open because being open allows you to interact with the rest of the world, and it provides you with an advantage as the rest of the world closes off. And then the third point was about capital account openness. Currently, that serves kind of as a risk to the euro area. Chinese liberalization is an external risk, but it's what's kind of excluding the renminbi today as a potential anchor currency. And so we saw this have large effects both in determining the structure of the international monetary order, but then at the same time, the fiscal stakes are immediate and quite large because interest rate payments can be quite large. All right, thank you for your attention. I'm looking forward to the discussions.
Okay, thank you so much. Dima, Mukhin is the first discussant. 15 minutes.
Okay, I'll try to do my best. Okay, so thank you so much, Şebnem, for organizing this event and for inviting me for the opportunity to discuss this paper. I mean, effectively, I'm discussing not just one paper, I'm discussing a whole big research agenda, right? So, okay, Tarek, Hassan, and co-authors tetralogy in a way, right? And so it's ambitious, but in some sense, I'm really glad I have this opportunity to go back and understand many things that, I thought I understood, but I realized I didn't understand deeply enough. Okay, so just a very quick summary of this agenda, right? So it starts with two papers. The first one by Tarek, his job market paper about the effect of the size of the economy on the global stochastic discount factor, and through that on the risk premium that countries pay. Then the second paper about the incentives for other economies to peg to this currency. And then more recently, right, they have a paper talking about effects of US tariffs and how much that affects exorbitant privilege, decreases exorbitant privilege, and undermines the anchor status of the US dollar. So in a way, right, you can kind of summarize it using a picture, the following picture, right? So you have tariffs and capital controls as two policy instruments, right? For different, some other unrelated reasons, you impose these two constraints, these two instruments. They affect the effective size of the economy. That affects how global stochastic discount factor depends on your own shocks. That determines the risk premium, and in the end, that changes how much you pay at what interest rate you can borrow, and the anchor status of your currency. So now, what this paper brings, this fourth paper, right, brings to new. So it focuses on the role of the euro and under which conditions can the euro replace the dollar and also outcompete renminbi as a global currency, as the currency with the highest also safety premium. And so in the end, and I think so I read the draft and wrote my summary. Tony just showed his summary. It seems like it's exactly the same points, right? So in a way, what are the recommendations, practical recommendations for policymakers? First of all, the Europe needs, Eurozone needs to stay open to third countries. It needs to integrate more, and it's not just adopting the euro, but also kind of making fundamental shocks more aligned across countries. And finally, right, it kind of needs, luck or, this exogenous shock, which it can't really control, that China keeps its capital controls, US imposes tariffs, and as a result, both the US dollar and renminbi cannot play this role. Okay, and in the end, right, this is kind of the main quantitative results. So that will decrease the interest at which Europe can borrow and economize about hundreds of billions of euros per year, and increase capital, wages, and GDP. Okay, good. So I thought I would prepare, a big picture discussion, but in the end, I got so interested into the mechanism that I ended up with a much more academic discussion. Sorry about that, but hopefully this will be useful, at least for some people in the room. So what I want to do, I want to go through 1, 2, and 4. Okay, I will not talk much about 3, but I want really to kind of dig deeper into these papers and understand how robust results are, what is the economic intuition. And just to preview, I think the first step, this effect of size on the risk premium, I mean, this is very robust, and I will show that even in other environments, which maybe I find more realistic, you still get the same result. The second result about the anchor status of the dollar, there I think the intuition, maybe my intuition at least is slightly different from how the paper explains it. And then finally, I will talk briefly about whether it's actually a good thing for the EU to become, for euro to become an anchor currency. Okay, so let me start with the kind of the foundation of the whole thing, right? The fact that size matters. So let me kind of strip down the model. So just leave the most basic ingredients, okay? So 2 economies, it's an endowment economy, no endogenous production. There is exogenous supply of tradable, non-tradable goods across states. Markets are complete. I will talk about implementation with particular portfolios later on, but for now, markets are complete. And preferences are the same as in the paper. I realize that I still use old notation relative to the presentation. This is a notation from the draft. So gamma is inverse of intertemporal elasticity, and tau is the share of tradables, kind of openness of the economy. And so given that this is a complete markets environment, there are no frictions, we can just solve the global planners problem, right? So what is the optimal allocation? I mean, clearly, consumption of non-tradables per capita is equal to the endowment. And so the only thing is how you allocate tradable goods. Solution is trivial, right? You just equalize marginal utility from tradable goods, and you can kind of solve it together with the resource constraint and get everything in closed form, okay? So there's this parameter alpha. I mean, you can already see that having gamma greater than 1 is important, right? So you want this intertemporal elasticity of substitution less than 1, while because of Cobb-Douglas, intratemporal elasticity is equal 1. And then you get this solution. And so here are kind of the main takeaways, right? So there are 3 potential output shocks. It can be non-tradable or tradable in each country. And it turns out that no matter which one goes down, it's always kind of a bad state of the world, right? So this is exactly what you get from this elasticity, is that the tradables, non-tradables, they enter stochastic discount factor in such a way that no matter which endowment goes down, you always get an increase in the SDF for tradable goods, right? So this is a bad state, but the response of the exchange rate will be different, right? So in particular, if it's an endowment of non-tradables in the home economy which goes down, their price goes up, so exchange rate, the domestic exchange rate, appreciates, right? If it's a foreign non-tradables which go down, their price will increase, and so real exchange rate will depreciate. And you can see, right, so in the first case, you can say that the home asset is safe, right, because it's a bad state of the world and exchange rate appreciates. In the second case, actually, it's still a bad state of the world, but exchange rate depreciates. So in that sense, the home asset is a risk. And in case of tradables, it's just neutral. You don't have any movements in the real exchange rate. So what you want, right, so how can you make the home asset being safe? Well, you need, the first shock to dominate, right? And that's exactly kind of captures the idea of the country size, right? So if US is larger, then, theta, the kind of this parameter, Pareto weight effectively, it's higher. And so the non-tradables in the home economy will be the main driver of SDF. And so home assets will be safe. So you can think in this, oversimplified environment, how can you think about tariffs and capital controls? Well, I mean, the way they do it in the paper, it's much more kosher. They just put a wedge in the risk-sharing condition. I mean, in more reduced form, you can just think of this as decreasing of number of people participating in this global risk-sharing in the home economy, right? It's as if theta goes down, right? You just give local non-tradables to some of your home agents, and they don't participate in financial markets. They don't share the risk, and they don't kind of trade. And as you can see, right, as theta goes down, it kind of tilts SDF, the effect of the way SDF is determined, towards foreign endowment shocks, right? Domestic endowment shocks play smaller and smaller role, and so home asset becomes more risky, right? It loses this risk premium. Okay, so 2 kind of comments, questions, robustness. So the first one is that, I mean, in this model with tradables, not tradables, so they discuss tariffs, they discuss capital controls, but in a way, this is just the same thing, right? They're completely isomorphic. Both result in a wedge in this risk-sharing condition. It doesn't matter whether you can't ship the goods or you can't trade the assets. I think conceptually, it's actually quite interesting. No, are these 2 policies really the same in terms of effects on the SDF? And here it seems like a more natural benchmark is something like Galli-Monticelli, right? So the model with home and foreign goods, where you can distinguish the 2 mechanisms, right? You can look, okay, in the interest of time, I will not do this very carefully, but in the end, so what you can do, right? You can write the, again, complete market risk-sharing condition, the market clearing for goods, right? Relative supply of goods, relative demand, and expenditure switching term. And then you have also net exports. And so you solve the model. I mean, the good news, robustness result, is that you get exactly the same effect. So if it's, if it's domestic good endowment which goes down, it's a bad state of the world, but exchange rate appreciates. If it's a foreign, you get the same effect on the SDF, but exchange rate depreciates. So, still goes through the intuition. And if you have more shocks in the home economy than in foreign economy, you still get that home asset is safe. But what is more interesting, what you can do in this exercise, you can distinguish these two limiting cases, right? You can look at trade autarky. It's as if countries cannot trade because of tariffs, right? So that corresponds to this tau parameter going to zero, openness of the economy going to zero. And you can separately look at the financial autarky, right? When you can't trade assets, and as a result, net exports has to be equal zero state by state. It turns out, again, qualitatively, under their parameter restrictions, it both work in the same direction. So it's true that you still have that risk premium goes, or safety premium goes down in both cases. But I think, maybe it's a work for the future to do this analysis more quantitative and maybe see if there are any interesting differences. It's also, my kind of wish, to do wish list for future research, not for this paper. I think is also to think more seriously about industrial policy, right? That's another thing that is now very widely discussed in policy circles. And so, what are the implications? Is it just increasing the size of the economy, or, for example, if you just shift resources from non-tradable sector to tradable sector, will that actually increase the safety premium? And it's not obvious, right? Again, in all the results that I showed you so far, it was more about non-tradables. The tradables actually don't play such a big role, your endowment of tradables. So maybe it's actually undermines safety premium, but so that's something to be discussed. Okay, and then another thing is that in the end, okay, do we really believe that endowments of tradables, non-tradables are the key drivers of exchanges? I think unconditioned, that's definitely not the case. There is a huge literature about Balassa-Samuelson effects, and okay, in the long run, it plays a role. Within monetary union, it plays a role. I think, for countries with floating exchange rates at higher frequencies, it doesn't play such a big role. But what is interesting is that even for kind of conventional shock, financial shock, you can actually get very similar results. Okay, again, let me go it very quickly. So you take the risk-sharing condition, you put financial shock, kind of risk-sharing wedge here. Let me abstract from endowment shocks. They're both zero. I still have market peering conditions, but I will assume that foreign country is small, because otherwise countries are symmetric, and clearly, there is no reason why home should be safe. So the shock, right? The shock is kind of symmetric. It enters symmetrically into risk-sharing condition. So you solve the model, and interestingly, you get this result that the home asset is safe. And why does it happen here? Because home economy is closed, right? And all this risk-sharing wedge, in the end, it ends up in the consumption of foreign households. And so to hedge against this shock, they actually want to hold home asset, not foreign asset. Okay, and so and then you can do kind of the similar comparative statistics for tariffs and capital controls. So that, I think, is very good news, and I was very reassured when I saw this. Okay, now the second part. So what about anchor currency? And this is where I think things get a little bit more difficult. So we talked, I think, with Tarek before that, with other people, and the words kind of make sense, but I always felt like I don't understand really the result. And I think now finally I got it. So here is how it works. So think of us, again, static model is the same model, small open economy. Let me go back to non-tradables and tradables. But now let me take seriously how you implement this risk sharing, right? The portfolio choice. So there are only, Lucas trees for non-tradable goods, and countries, households, they can trade shares in these two Lucas trees. Okay, so this is, you have ex ante before uncertainty is realized. You choose positions A and A star in home and foreign assets with prices Q and Q star. And then in the second period, right, you collect dividends on these two assets. You get some endowment of tradable goods, and then you use this for spendings. There are, foreign investors order equations, and there are market peering conditions. And the planner can kind of, right, at the background, it can manipulate consumption of tradable goods. So that's, this can be FX interventions, it can be capital controls, other policies. Okay, so first result, and again, it's kind of makes sense, but I think it's an important benchmark. So if you take this model literally, the way I wrote it so far, and it's a model with complete markets effectively, so any interventions are suboptimal. It's already a first best economy, right? It's complete markets. There is no externality within the country to exploit. There is no terms of trade externality because it's a model with tradable goods. So in the end, there is, you can't improve welfare. There is no government intervention that would improve the welfare. I think that's the benchmark. But then the policy that they consider is the following, that suppose that portfolio is already chosen, right? Agents thought that there would be no policy intervention. They take some positions in two assets, then the policy is announced, and the policy here, think of this as a peg, okay? And that creates valuation effects on these portfolios, and that kind of redistributes wealth across countries, right? And I mean, you can reinterpret that as kind of maybe more incomplete markets, but the idea basically is that there's kind of this unexpected policy announcement which creates valuation effects after the portfolio is chosen. Okay, I thought, okay, finally I understand this, but it turns out that that's not enough, right? Because if you think about this, so what they say, the country implements PEG, so now home currency looks very much like the currency of the large economy, so it gets this safety premium, so which means that the assets, the price of assets increases, right? But usually we think that if the price of home asset increases, it's actually a negative valuation effect, because part of home assets is held by foreigners, and if you increase that price, it's a valuation effects towards foreigners, right? That's, you know, Helen's and Pierre Olivier's original point in their paper. So that's not enough. So what happens here effectively is the small open economy takes long position in the local currency and short position in foreign currency. That's kind of a bit unusual, right? That's not how we usually think risk sharing works. So it's not just home bias, right? You need to hold more than 100% of your domestic asset and a negative position in the foreign currency. And then, of course, right, if you increase the value of domestic asset, because foreigners are short in that asset, you will create a redistribution towards your economy. But again, it's, you know, it's okay. So yeah, I guess I don't really have time to show this, so let me skip this, but okay. You can show this again in this toy model, you can show this in closed form, it's very nice. Let me instead just go to empirics. So is it really kind of a realistic thing? Well, I was actually surprised there are a few countries which have such positions, but it's about 7 countries out of 50 for which data is available, right? So you take foreign currency in assets and liabilities, and you compute this net exposure, and it turns out that for about 43 countries out of 50, so I guess 86%, you get that exposure to foreign currency is positive, not negative as in their model, right? And symmetrically, if you look at the position in the local currency, it's mostly negative, right? I mean, that's what I would expect, because, you know, I usually think about US portfolio. It turns out it's true for most countries. So I'm not completely sure how to kind of, you know, is there a way to get realistic portfolios in the model and at the same time have the same mechanism? I thought about this a little bit. To me, it's just not obvious, right? But I think that this is an important thing to understand how the model works. It's not just, you know, again, it would be naive to say that as long as you decrease the risk premium, that necessarily increases welfare. No, you need more than that, right? And the complete markets without externalities, that's not the case. You can manipulate your risk premium, you can make, you know, risk premium negative, but it will not increase welfare. Okay, finally, my last slide. So what are the implications for Europe? Is it really kind of, all these things, is it kind of good news for Europe? Well, okay, so it's true that safety premium will probably increase for the EU, so the governments will borrow at lower rates. I mean, I don't know whether it's a good news. I'm skeptical. I think they need some fiscal discipline rather than facing lower interest rates. But more importantly, that the effects on welfare is ambiguous. Okay, and in some sense, I actually thought first that it would be negative because you exclude US, you exclude China from global risk sharing. It seems like for other countries, it should be bad news, right? There are less room for them to share risk. It's not necessarily the case. It really depends on how correlated shocks are across countries. You can construct examples where our shocks are so correlated that you actually like that other countries don't need this transfers in bad states of the world. But that's ambiguous, and it will be interesting to compute this in the model. Now, in terms of other countries using the euro as an anchor currency, this is where results are unambiguous, and they also say it in the paper, right? That unambiguously lowers welfare of the EU, and also it dampens EU safety premium. Why? Well, because it's evaluation effect, right? It's evaluation effect from Europe to other countries. It can't be good for the EU. So you know, I think you learn something from this model that you might get your currency as an anchor currency in the world, but actually you don't want that. I think that's an important takeaway from the paper. And so, you know, to kind of conclude, I think, you know, it's not just this model. I think, you know, I worked more with models where dollar is used as a currency of invoicing, and there you get the same results. It's very non-robust, or sometimes it's actually the opposite, counterintuitive result that actually it's bad for these countries to have their currencies used as a dominant currency. So I think it's ambiguous. What is not ambiguous, I think, is that both integration, openness, they have benefits on their own, right? It's kind of nice if they also maybe promote your currency in a way, allow country to borrow more cheaply, but this is second order and it's more ambiguous. I think direct effects of the integration and openness are more important. Thank you.
Thank you, Pierre. Deleu is our second discussant, 15 minutes.
Can I quickly just say something while you put the slides up? Because I think it's kind of complicated and it'll get lost later.
Sure,
Yeah.
but very quick, because you are going to get the chance to answer both
I
discussants.
understand. So the asset revaluations, I think, make more sense when you think about it in terms of stocks. Like, I am the monopoly supplier of my firms. And if you think about this in a dynamic world, like every period I can produce some firms and float them on the world market. And then you don't really need this kind of weird thing about the surprise and the weird bond holdings. But I agree with you that these... I'm not sure about that, but yeah, we can talk about it.
Okay, we'll discuss this later. All right.
Thank you. It's an honor to be part of this forum. It's a pleasure to read the paper and thinking through it. So the paper asks, under what condition would the euro emerge as the world anchor currency? That is the target currency that countries that peg would choose. And the paper takes a risk-based perspective on exchange rate determination. Under this perspective, one insight is that the optimal anchor currency is the one that appreciates in global bad times. The paper also shows that it is, under some conditions, currencies of larger economies that tend to appreciate in global bad times. In fact, it's the currency of the largest economy that appreciate most on average in global bad times. And it follows that policies that expand the effective size of the EU or the euro area make the euro a safer currency in the sense of its covariance, and as a result increase the euro's prospect as an anchor currency. So after briefly summarizing the mechanism, I'll do two things. First, I'll propose a test and implement a test of the model mechanism based on the properties of the euro and the pound before and after Brexit, which was an episode of EU change in EU integration. And then I'll sort of step a little bit outside of the model and think about how other shocks and possibly other policies alter the stochastic property of the euro and affect this discussion about the potential of the euro as the anchor currency. So in a simpler version of the model with integrated markets and laissez-faire, the bilateral real exchange rate between home and the foreign economy is inversely proportional to the relative supply of non-traded goods. When the home non-traded goods deteriorate, the real exchange rate appreciate. Here the convention is that the real exchange rate increases. And that's meaning that the price of non-traded good at home will be larger than the price of the non-traded good abroad. Now in this model, obviously, a deterioration of a home non-traded good under some condition increases the demand for traded goods, increases the marginal utility of traded goods. And that's why the global stochastic discount factor, SDF, which is the marginal utility with respect to traded good, it's also reflective of the country's non-traded good supply. And it's reflective of this non-traded good supply in proportion of the country size. When a large country non-traded good supply deteriorates, its exchange rate will appreciate, and this will also imply a large increase in the marginal utility of traded goods in the SDF. To the contrary, when a small country experiences a deterioration in non-traded goods, the effect on the global SDF is much smaller. And that implies that the covariance between the bilateral real exchange rate and the global SDF depends on the relative country size, home versus foreign. When a home country is bigger than a foreign country, the bilateral exchange rate appreciates in bad time. The currency of the larger country appreciates versus the smaller country in bad time on average, and vice versa, precisely because its shocks appreciate the home currency exchange rate, the home country exchange rate, and are more reflected in the global SDF than the one of the small economy. So I want to illustrate the way in which the authors interpret the process of integration or disintegration. In fact, I will do that in the context of an application to Brexit, the case in which the UK withdrew from the European Union. So in the model, the UK broad real exchange rate index depends on the UK supply of non-tradable goods in this simpler version of the model. And the way the authors interpret integration or lack thereof is that when the UK is integrated with the EU, its non-traded goods shocks are affected with the EU non-traded goods shocks. So there's a perfectly correlated shocks. And that's the case before Brexit. After Brexit, or after the effective withdrawal, the UK real shocks would be idiosyncratic and independent of EU shocks. Okay? So this simple observation leads to sort of three implications, three testable predictions. The first is that the pound is expected to depreciate more relative to the dollar in bad times after Brexit. In fact, so remember I said the covariance depends between the UK and the US exchange rate depend on the relative size, because the relative effective size of the UK has declined after Brexit. Its covariance is more negative with the global stochastic discount factor relative to the US. For the same reason, because the EU size has effectively declined with the exit of the UK, we should expect the euro to depreciate more relative to the dollar in global bad times after Brexit than beforehand. And in terms of pound versus dollar, you should expect something similar. The pound becomes a more riskier currency relative to the euro, I meant pound euro, after Brexit. In fact, you should expect the pound and the euro to move very tightly before Brexit as a result of their perfectly correlated shocks in the simpler version of the model. Okay, so I go to the data, and in particular, I take daily exchange rates, different currency pairs from 1999 to 2026. And the metric here of safety, which is sort of motivated by the paper, is the correlation in daily changes of a given exchange rate with daily changes in the VIX, which is my proxy for the global SDF. So here I first report the correlation between changes in the UK-US exchange rate, the correlation with the VIX. And what you can see is that indeed the correlation has significantly declined post-Brexit. That implies that when the VIX increases, the pound depreciates relative to the dollar more after Brexit than beforehand. So the pound has become a riskier currency relative to the US dollar. That has been the case also for the euro relative to the dollar, although to a lesser extent, which you would expect through the model, because the UK size is not a large portion of the EU size. And that implies that if you look at the pound-euro exchange rate, which would be the last set of bars, the pound started depreciating significantly relative to the euro when the VIX increases after Brexit relative to beforehand. So this is broadly supportive of the model predictions that indeed currency safety is increasing in country size. This figure focuses on the pound-euro exchange rate, and it's a 4-year rolling window regression of pound-euro exchange rate changes on changes in the VIX. What you can see is that before Brexit, the pound-euro exchange rate wasn't very responsive to changes in the VIX, which is consistent with the notion that it reflected correlated shocks between the UK and the EU. But afterwards, it decoupled, and it decoupled in such a way that is to be interpreted as the UK pound being more risky than the euro afterwards. Consistent with the model, you also have that UK 10-year bond yields are significantly larger after Brexit relative to the German counterpart than they used to be. And interestingly, and this is a bit outside of the model, but I think related, we started observing that UK exporters have started pricing their export in US dollar after Brexit more prevalently than before, which is intuitive if you think about the desirability or lack thereof of having your price sticky in a currency that depreciates in bad times. Okay, so the first point to me is that Brexit is an interesting example of change in integration, and I think that looking at the stochastic properties of the relevant currencies before and after, it's broadly supportive of the model ideas. My second point starts from the observation that in the model, shocks that raise the country marginal utility of traded goods are shocks that appreciate the home real exchange rate for a given country at a given size. Okay, and so for the sake of illustration, I want to consider another class of shocks, and in particular, I assume that the home country now faces relative demand shock between tradable and non-tradable. These are shocks that all of a sudden make the home country like tradable more than non-tradable. These are shocks that very naturally increase the marginal utility of traded goods and contemporaneously depreciate the home real exchange rate. So it's the opposite movement. And because they imply the opposite movement, they have the opposite effect on the covariance of the home real exchange rate with the global stochastic discount factor. Okay, so in this slide, the last term captures the contribution of these relative demand shocks to the overall covariance of interest. And as you can see, enter with a negative sign, they make the country currency riskier, the more prevalent they are. Moreover, as you can see, that term is scaled by size. Here, any shock is scaled by size. And so if the home country experiences large relative demand shocks and becomes bigger, this will make the currency more risky rather than less risky. Okay, and that's again because these are shocks that depreciate the currency and contemporaneously increase the SDF. Okay, so the opposite. Now, I want to say that I'm not particularly attached to these shocks. They're just time-varying shares in the Cobb-Douglas aggregator, and I'm not saying these are particularly empirically relevant, but I want to say that thinking a little bit outside the model, I think it's conceivable that there are forces, like financial forces, that tend to depreciate the home exchange rate when the home marginal utility is high. This could be for a given country size. It could be like countercyclical, sovereign risk, sudden stop, shocks that make domestic assets less attractive, precisely in global bad times, and so depreciate the exchange rate, making the country currency riskier. And unfortunately, I think these forces are not unfamiliar to the EU or the euro area. So the broader point is that if the euro depreciates in bad times for structural reasons, not just because of country size, then integration alone may not improve its safety properties. And in some sense, conceptually, it can be counterproductive. But the broader point is indeed that these policies of integration and enlargement may need to be complemented by policies that strengthen the euro safety properties. And in this sense, I think it's interesting to think about how other policies that are either discussed or implemented in the context of the EU and the euro debate affect the euro's properties, the euro stochastic properties. And for instance, it's interesting to think about euro bonds, and if designed a certain way, euro bonds would reduce the sensitivity of sovereign risk premia to the cycle, which would also be beneficial for the safety properties of the euro. And this is a potential benefit that goes above and beyond the euro bonds provision of a euro-denominated safe asset, which is another very relevant and important thing, but distinct. You can think about how asset purchase policies change the stochastic properties of the euros, it turns out that theoretically it's ambiguous. And again, I'm not saying that this policy should be designed to alter the stochastic properties of the euro. I'm saying these policies, which are designed for a number of stabilization reasons and risk sharing, they do alter the stochastic properties of the euro. And if you really embrace the notion that a key feature of an international currency is its covariance with the global SDF, its behavior during periods of heightened global risk, then I would say that it makes sense to consider how your broader macro policies affect that important metric. And so to conclude, I think the paper takes this risk-based perspective on exchange rate determination. I find it relevant, intuitive, in fact, fascinating way to think about equilibrium exchange rate and exchange rate policies. I think it helps explain the behavior of the pound and the euro before and after Brexit, which is quite interesting. But it also raises the question of, first, what are the set of shocks that we think are most prominent when it comes to euro and the euro area, and how do macro policies more broadly shape a country's safety properties and, as a result, its international borrowing cost and its potential to be the world anchor currency. To conclude, I think the euro may still have a long way to go to become the world anchor currency, but it is within the reach of EU policymakers to go in that direction. Thank you very much.
Okay, questions, please put your name up. Okay, I'm going to start there. Oh, Tommaso, where is your thingy? Okay, fine. So yeah, please follow the rules. Okay. Okay, you go.
Thank you. Very interesting paper. I have a few clarifying questions. One is, if I understood correctly, the paper is based on stabilizing the real exchange rate, which seems weird to me. It's an endogenous variable. Practice is very difficult. That's one. So if you can clarify that. Then, on a practical matter, if Europe would be the new reserve currency, would that imply that they'll have to run current account deficits? And the third one is also another clarifying question, is that when you think about the mapping of GDP size and financial debt deepness, what role does the network effect play? Because I tend to think that, maybe I'm wrong, but it's not the size of the economy, but the depth of the financial markets and the network effects that make you accept dollars even if you're not trading with the US. So if you can clarify how that works, that would be
Awesome.
So thanks. I thought this was a really interesting paper, and the whole agenda looks very handy, especially for teaching. So and think about this issue. So I'm wondering. I have just one point. I'm wondering about global imbalances, right? So I'm wondering whether there is a sort of an elephant in the room of this model, which per se should not have implications for global imbalances because it's static, right? But now, if I think back of the work of Quadrini, Mendoza on the equilibrium implications of financial integration, right? It seems that financial integration in this environment would generally generate an increase in global imbalances, right? So, and I'm not saying this is a dark side, because not necessarily. No, what I learned from Mendoza, Quadrini, and Rios' role is and work is that this is not per se negative, right? It's an equilibrium implication of basically smaller countries integrating with the large country and exporting precautionary savings, right? And the large country importing precautionary saving and issuing debt, right? But I guess it's an interesting thing to mention as a possible additional implication if the model were made dynamic. So, yeah.
Murray?
Yeah, very interesting paper and presentation. I had 4 points to make. Nicolás made the first one, which is, I guess, a natural one coming from the IMF. But I want to expand it a little bit. Particularly for small open economies, pegging the real exchange rate is going to be very hard. Most countries, when they peg the nominal exchange rate. If you're small and open, and this is a point that really comes from Mukhin in the 1960s, a lot more of your prices are linked to world markets, and so you just can't stabilize the real exchange rate in the way that you could maybe in the short run for a large economy with sticky prices. So I think that's a real issue. I think the number of countries that peg to the dollar is a very partial measure of the dollar's global role. It's of course related to the broader roles of the dollar, but it's the anchor currency role. But if you look at the roles in funding markets, in invoicing, all of those are much broader. And that brings me to my third point, that a large part of the covariance between the U.S. economy and the world economy is driven by Fed policy and by this large global footprint of the dollar. It's not just that the U.S. is large, but that's part of it. But there are many other elements there, including the depth of U.S. financial markets. My last point is about the description of the effect of Chinese capital controls. It was kind of presented, if I understood, as a factor that reduces Chinese footprint in global trade, basically. But if we look at how China does implement capital controls, essentially they don't limit its effect on trade because they, the PBOC, state banks all act as financial intermediaries. So yes, there are controls on the private sector, but not on the public sector. And so China's footprint in global traded good markets is huge, and its capital controls don't affect that. They do affect its status as a global currency, because it denies China the advantages of open financial markets that the Eurozone has and that the dollar has.
Okay, great, Helen.
Thanks, great session with great presentation and discussions. So I have a few points. So some of them touched upon by Maury, but so I'm going to start with the risk sharing element of a model. So indeed, as was pointed out by Dima, so when you have shocks, it depends which shocks you have in order to get this real appreciation versus real depreciation of the exchange rate. So in order to get the real appreciation, you need to have a dominance of the non-traded shock in the US non-traded shock, which from a quantitative perspective, if you have a US economy which is 25% of world output, actually when you calibrate the model, you're not going to get that shock dominant. You are going to get other shocks dominating the co-movements. Now, as Maury just pointed out, however, maybe if you want to interpret size differently, which is the size of the US footprints on global capital markets, and if you do that and you are more in a kind of risk on, risk off global financial cycle style of idea, then you're going to get more action, I mean, quantitatively. But another thing which is kind of related is that if the US as issuer of a reserve currency is insuring the rest of the world, what it means is that in bad times, you should see resource transfers from the US to the rest of the world, which means essentially transfers of traded goods to the rest of the world, which is a kind of decrease in the US trade deficit, which in this risk sharing model is tied to real depreciation of the real exchange rate. So that's a difficulty that Matteo also pointed out in his paper, etc. So that's a kind of reserve currency kind of paradox, which is a bit hard to overcome in this kind of risk sharing models without additional friction. So that's one thing. but again, I think if there are ways of going around that, and if you think about size not as GDP size but as more financial market size, then I think that's probably does it for you. Another thing is that Maury mentioned is that indeed the anchor currency and the risk-sharing view. I mean, as you know, I'm very sympathetic to that view as well. But indeed, it's a very kind of like silo views in a way of the role of the US dollar in the international economy, because the anchor currency role is tied to the reserves role, is tied to the invoicing role, is tied to the liquidity of various financial markets and trade volumes, etc. In a way, size plays also a role there in terms of network externalities, right? Liquidity, size goes to network externalities. On top of, there are other dimensions that are very important, such as fiscal stability and the role of the fiscal backing. And so a lot of these stylized facts about risk have also to be looked at from a point of view. So there's the liquidity dimension, but there's also the fiscal dimension, and some of the stylized facts on Brexit could also be interpreted in that, with that thing. The last thing I wanted to say about from the point of view of the euro is that what's a safe currency is that in a way it should appreciate in bad time, and also yields should go down in bad time under stress. And one of the fundamental issue of the euro area might not be, I mean, so much, going more towards more country, which I agree would help from a network externality point of view, but the financial architecture, right? If you have capital flight out of the periphery country to the core country, like the Bund, the spreads increasing, etc., in bad times, that really undermines the safety of Europe. And this is why a lot of the policy debate has been about how do you have a much bigger fiscal capacity, or how do you create a common safe asset, essentially.
Okay, great. So yes, you guys have, a little bit over 5 minutes to answer. Well, actually, no, you have more than that. Our break is at 11. We go to break at 11. Yeah.
Well, thank you very much. These were excellent discussions. Like you guys really dug into the paper, and very good comments. Thank you very much. I wanted to hit. There's a lot of questions. I wanted to hit like kind of 3 macro points first. So let me first say, so I think the way that you should read this paper is not as a literal description of the world financial system, but more as essentially our first order approximation of it. So I should just point out that like we lack any equilibrium model currently that essentially replicates the architecture of the world financial system. This is our first shot. So in the sense that, like, the dollar's endogenously at the center, small countries stabilize, large countries float. So this is the framework that produces it. It's a highly stylized framework. So the way that I think we want you to read the paper is that the debate about dollar dominance is a lot about institutions. So, and there's a lot of important contributions in that debate that I don't want to minimize. But what we show with this line of research is that you can think about dollar dominance without thinking about the Fed, without thinking about international clearing, without thinking about which currency is oil denominated in when it passes the Strait of Hormuz. What are US banks doing? All these things might be important, but what we're showing here is that at the core of all of this, in a very basic economic model, this is basically the Becker-Smith model with bells and whistles, right? So in a very basic economic model, you get dollar dominance out of essentially 2 things: size and openness, if you want openness of the trade account and openness of the financial account. That's what you should take away from this paper. Not that all these other things are not important. So both discussants and also Helen kind of hit on of course, our theory rests on basically being approximately right about what moves exchange rates. And that is, as a profession, we're not super good at that question. And we're not really changing anything about that basic problem in our field with this paper. Pierre gave a very good example of, you can think of shocks that make you appreciate and reduce absorption at the same time. Those are not the normal shocks that we usually think about, but you can construct examples where when I appreciate, I import less. Normally in our models, pretty much any shock that makes you appreciate also makes you want to import more. And that's exactly the boundary. So if you think that on average, the shocks that move exchange rates are such that when you appreciate, you tend to import more, then our theory is going to work. If you think that we live in a world where there are other shocks that are like specifically about how much do I like the traded good today relative to other things and so forth, then the theory shouldn't work. But it has like some empirical support in the sense that it reproduces like the structure of the international monetary system and produces a bunch of predictions and asset prices, so it's not totally wrong, I guess. But that's the logical boundary. We had a lot of questions, both from Dima and in the discussion about the rationale for stabilization. And Dima, thank you for digging that far into the paper. I should say that like the fact that the normative behavior here in this model works out, and we get like without any frictions, basically. So I should kind of say, the only frictions that you need to get the dollar to be the anchor of the global monetary system is that the only assets that are traded are stocks and bonds. You don't get to have error-diverse securities. If you have error-diverse securities, then indeed nobody stabilizes their exchange rates. If you take away the error-diverse securities and the only thing you can trade is stocks and bonds, the model says that although the global social planner doesn't want anyone to stabilize, small countries will deviate and will just go ahead and stabilize. That's what the model says. Now, I think that's kind of a miracle, and we did not expect that to happen, and I don't think we actually necessarily believe this normative way. This is just like, in some sense, this got us past the Minnesota referees to sort of get the paper published. So in the first version of the paper, we made a different point, which is, if you stabilize your exchange rate, you get to lower your interest rate, you endogenously raise your wages, and you generate revenues at the central bank. And there's a large literature in political economies that like that is a policy that a policymaker likes, even if it would decrease national welfare. Now, so therefore, you know, so we love that this thing works out in equilibrium, and maybe now that we've written, like Tony maybe believes it more. Like, so we had lots of debates about like, you know, is it important that sort of like the you know, like in this sort of like, you know, white box version of the model, politicians like the national central planner actually wants to stabilize. So you can think of this model without the normative part in some sense by just writing a political economy version where I'd like my central bank to make money on average. I shouldn't talk too long. So, so Helen,
Tarek, let me interrupt a little bit. What is important for us, of course, the euro side of the paper, the euro implication, and you know, maybe you can address some of those comments, especially from Helen but also Pierre and Dima.
Yes,
because that's important.
So I think what the paper suggests is that the way you become the anchor currency is openness, primarily. Maybe you also need a deep euro-denominated sovereign bond market, which, you know, I'm very sympathetic to, but the paper suggests there's an underlying fundamental, which is you want to be the heavyweight in the world economy.
You want to keep your maybe word, which is, you just said you maybe they need a bond.
The model has nothing to say about that. There's no institutions, there's no Fed and so forth. So, yeah, so, but, you know, the way I would read this is that the way that you synchronize your shocks is by having a common fiscal policy. Is that a controversial thing to say? I think that's like, you know, that's a way of integrating your economy by integrating the fiscal side. Yeah. No, again, I'm not against all these things, but it basically says, so there's not like a magical sort of, you know, we're going to have a trade alliance here and there, and sort of like, but the fundamental, and I viewed it. So we have many theories of of currency dominance, right? All of them basically start with let's make either the dollar the safe currency exogenously, or let's have the dollar be the one with the lowest interest rate. And then you can write models where, like, we're going to do currency invoicing in dollars, we're going to do all these other things in dollars. But in some sense, you need to start with basically where we end, which is you need to have a safe currency that is cheap to borrow in.
Let me just ask here, because if the the whole financial and the bond is out of the model and it is about openness and size, and let's just have the EU bigger and enlarge and all that. Okay, but then that has to that is the implication of the model, because it directly links to the correlation of the shocks and then integration, right? But then this, even you ignore the financial side, this goes back to the original optimal currency area literature with the endogeneity of the correlation of the shock to the integration itself.
Yeah.
So that has to be somehow addressed.
Yeah. So I think there's a very interesting. One interesting result that comes out of our calibration that we were trying to fight it. Nobody picked up on it, but like we were trying to make expanding the currency area more important than the real side integration, and it's impossible to do. So now you might say expanding the euro will harmonize stuff on the real side, which is what this literature is about. But essentially, the model really insists, our calibration really seems to insist on integrating the real shocks as the most important thing. Do you guys want to?
I arrived late. One small comment. I mean, there's a finance literature on size and why the largest guy wins, which is related to your endogenous prices, which is, if you're larger, financial markets are there are lots of flows going on. And if you're larger, the price impact of those flows is much smaller, and therefore your endogenous becomes safe. Krishnamurti and he and many literatures like that.
Yeah, so I think our model is like so these models tend to need a coordination device. Yeah, so you start with two currencies, and one of them sort of like just has a deeper market. I sort of view our model as basically being like, this is the coordination device. You're the largest one, so you're going to start out with the lowest interest rate, and now people are going to pile into that market. I think, but I do think it's important which view you take on this, right? So do we take a view that we can have basically do something on the financial side that kind of trumps these real considerations, right? So how important is this coordination device in the beginning?
It's a history dependence type issue. You were big at some point.
Yeah.
That gave you the deep market.
Yeah. So I like the Valchef, the Valchef and Tahoe and Valchef paper for this, for example, where like you get locked in, right? So then there's sort of, and we have no. I think we're at the very beginning, basically, of having this debate. But basically, the question is how big are the forces that lock you in? How big are the institutional forces that lock you in?
Okay, half an hour break. Let's keep talking and be back at 11:30. Okay, great. So our second paper of today. So Alejandro is going to present lessons from populism in Latin America.
Perfect. Thank you very much, Şebnem and Clemens, for inviting us to the conference. And well, this joint work with Nicolás and with Antonio, and we're going to present, half of the paper is going to be presented by me and half of it by Antonio. We started this project in 2018. The three of us were working at the IMF, and we were working with many of the countries that are addressed in this presentation. And it was kind of the end of the third wave of populism in Latin America that started in the beginning of the 21st century. And it coincided with a commodity boom and presented, I think, significant characteristics that warranted a study of this period. Then we put the project on the freezer, and last year and the beginning of this year, with the demise of the Maduro regime in Venezuela, with the election in Bolivia, etc., it was very clear that wave of populism was over, and it was time to close this project. So with Şebnem's invitation, we had the perfect incentives to finalize the paper. What we do is, first, we try to take the most exogenous and current definition of populism taken from the political science literature that was discussed yesterday, and we try to answer these four questions. What economic policies and institutional policies do populist leaders pursue? What are the macroeconomic consequences of their regimes? How do populist governments affect institutions? And what is the role of external sectors in shaping the dynamics of these regimes? So when you, the question is why Latin America? And I think Latin America has a very long history with populism, starting in the 1940s with Perón, Getulio Vargas, etc. And it shaped the politics in Latin America for, I would say, all of the 20th century. Secondly, we had periods of both left-wing and right-wing populisms. Almost everywhere in Latin America, we have presidential political systems. Given that we study external conditions, Latin America it's extremely dependent on commodities, especially the Southern Cone, and it has been extremely dependent on changes in international financial conditions. Just remember, the Latin American debt crisis, the whole crisis in the 1990s, Mexico, the fall of the currency regime in Argentina at the end of the 1990s, etc. And finally, populism in Latin America has focused much more on economic issues than on other societal issues like migrations, identity, etc. So we thought that it was the right laboratory to try to understand how these regimes operate. I think it's also important to highlight that maybe in the last few years, we're starting to see a new wave of populism in Latin America, that some of the leaders that are, the image of this new wave are associated with other type of issues, like Bukele in El Salvador and security, Ecuador with a guy called Noboa also focusing on security, and obviously Javier Milei focusing significantly on economic issues like a more traditional right-wing populist emerging in Argentina. No? So let me, if we go to the history of Argentina and think about these three waves of populism, as I mentioned before, the first one from 1930s to 1960s, it's, characterized, as I said before, by Juan Perón and Getulio Vargas in Argentina and Brazil. Lázaro Cárdenas, I think it would be a little bit more controversial whether to frame him as a populist or not. It was more of a nationalist than a populist. But, by some categorizations, he falls into the populist camp. The main policies implemented during that period was basically import substitution, industrialization, state intervention, and labor protection, and all of this under a social process in which there was a huge migration from the countryside to the cities, a build-up of a manufacturing base, and therefore the political empowerment of this new labor class that provided the political support for this political movement. No? So in a way, the whole economic policy supported a political strategy to remain in power and to take advantage of these disenfranchised large segments of the population that will provide the political support for these processes. Then we have what has been termed the neoliberal populism period that comes after the Latin American debt crisis, after the lost decade of the 1980s, in which most of Latin American countries didn't grow in per capita terms. And out of that, and the Washington Consensus, the Brady Plan, etc., came some of these very personalistic leaders that engineer significant structural reforms in these countries. So the policies were opening up to the international trade and capital markets, a very large privatization process, trade openness, and fiscal consolidation. No? And I would say the most visible figures on that camp were Carlos Menem in Argentina, Alberto Fujimori in Peru, Abdallah Bucaram in Ecuador. And out of that process, and I would say, I mean, when you look at, came important economic crisis, especially in Argentina, with the demise of convertibility, this strong peg that Argentina had, significant periods of economic stagnation, etc. And out of that came the last wave of populism that was brought into power by economic crisis, but then sustained in power by the huge commodity boom of the early 2000s. No? So there you have, obviously, Hugo Chavez and Nicolás Maduro in Venezuela, Evo Morales in Bolivia, Rafael Correa, the Kirchners in Argentina, that basically took back some of the reforms of the 1990s. They significantly increased the size of the public sector, and they engineer a redistributive model, not only based in the government budget, but also in distorting the relative prices in the economy, especially in the labor market, and of significant public services like basically utilities. Now a little bit like the London consensus taken to the extreme. No, no, it's not a critique, but in a way, when you start distorting the economy, when do you stop? No, and these guys, sorry, but I mean, they had the fuel with the commodity boom, and basically, it wasn't a technocratic design policy. It was much more of a politically motivated policies there. No, in the paper. Okay. So what are the stylized facts that Antonio is going to present and we test in the paper? Basically, the existence of these favorable external conditions supported these regimes and generated the stylized fact number 2, that is basically helping these leaders to stay in power for a significant period of time on the back of huge fiscal expansions. Obviously, behind that, there was a very important process of real exchange rate appreciation. And I think something that we also test in the data, a very important process of democratic backsliding and institutional weakness. So what, I mean, this is basically just a summary of the duration of the populist leader. The classical period was the one associated with Perón, Getulio Vargas, etc., lasting on average 9 years, the neoliberal period being significantly shorter, and this last period of populism, left-wing populism in Latin America being significantly longer. And what, I mean, here we plot the coincidence of the very sharp increase in commodity prices with the presence of populist leaders and especially left-wing leaders in Latin America. The dotted line is the index of commodity prices for Latin America, and the solid black line is the incidence of populist leaders in Latin America, and the blue line, the incidence of left-wing populist leaders that in the, let's say, the first 20 years of the 21st century were prevalent in Latin America. In the appendix of the paper, we present 4 case studies. And I think these case studies provide a lot of support to, let's say, the correlations that we present in the empirical part of the of the paper. Now we discuss Argentina, Bolivia, Ecuador, and Venezuela. On the in these 4 cases, I would say Ecuador was the only case in which an economic crisis did not bring the populists into power. In the other 3 cases, it was either a sharp crisis or a prolonged period of stagnation. In terms of economic policies, in all of these cases, there were huge terms of trade windfalls for each of these countries. In the case of Venezuela, in 10 years, Venezuela got 300% of GDP in excess revenues from their oil exports, only because of the increase in the price. So 30% of GDP per year of additional income going into the economy because of this wealth effect. This generated a huge fiscal expansion. Basically, in these countries, government expenditure as a share of GDP increased between 10% and 20% of GDP in the span of 7 years. Many of these countries implemented very heavy-handed price controls in public utilities. Minimum wage policies were extremely aggressive in most of these countries, and also state intervention. I think something that we do not explore empirically, but we discuss in these case studies, the exchange rate regime played a stabilizing role or a moderating role in this case. Ecuador was a dollarized economy. And as we're going to see, the GDP effects of these populist policies were significantly lower in Ecuador than in the other countries. Bolivia also had a hard peg that actually withstood everything throughout this period, and also the GDP behavior during the period was much better than Argentina and Venezuela, where they had kind of crawling pegs, adjustable pegs, etc. That in the case of Venezuela descended into a hyperinflation, and in the case of Argentina, it put the country into very high chronic inflation between 30% and 100%, above 100% at the end of the 2023. And on the institutional side, it's interesting to see both the narrative and discourse of these governments, and also the significant changes they make towards a much more plebiscitarian democracy. In 3 of these 4 cases, they call for a constitutional assembly and they changed the constitution. In the constitution, they included, obviously, the significant re-elections of the leaders, and the combination of these constitutional changes plus the commodity windfall generated this very long period in which they stayed in power. In some cases, they significantly weakened the judicial system, therefore consolidating power under the populist leader. So the democratic backsliding process was, I would say, a feature rather than a bug of these regimes. All of these countries ended up having to restructure their sovereign debt, or some of them are still in default. All of these countries broke de facto relations with the international community, with the IMF, etc., by not conducting Article 4 processes, etc. And in a way, the exit of populism is proving significantly costly and long-lasting to reverse. Just see the case of Ecuador, the case of Argentina still struggling to come out of these populist policies. So with that, Antonio, I turn to you.
Thank you. I'm doing 2 things. First, I will talk about the definition of populism that came up yesterday and how this is very important. And second, to present some econometric evidence how this. First, when we started this project, we had a problem. What is populism? And so I had a bad idea of organizing a session with political scientists. I invited them and I asked them, could you discuss with us? There was Darun, I think, there were famous economists and some famous political scientists, including Rovira Kaltwasser, who is a big name in on populism. And he started the talk by saying, there is no sense, you cannot answer this question. It's a very ill-posed question. It's like to say how the political economy of your country depends on the color of the hair of your leader. It's no sense.
So the bottom line I have is that never invite political scientists to a level, because, or at least sign some kind of prenup agreement what they want to say before inviting them, before getting married to them, and this approach failed, and I asked them to send their paper and to understand a little bit more what they mean by populism and to see whether we could think something. So they send this, which is the definition. Just a second. Yes, this is a review. I can go later. They send what is the favorite definition now for political economy, for political scientists. They have various definitions, but this is the dominant and was invented about 20 years ago by Made and Kaltwasser. And this is very useful because it explains why they think that our question was completely ill-posed and explains why I think they are wrong. What they say is that it's a think-center ideology, which is their way to say that it's not a lot of substance. If you can be a populist and Marxist at the same time, a populist and neoliberal at the same time, a populist and a London consensus follower at the same time. So there is no implication on economic policy. Populism is a way of conceiving how the society is structured. And the society is structured in two groups, antagonistic, the elite, which are corrupted, and the people who are virtuous and nice and oppressed by the elite. So this is a very, very broad frame and so on. So if you are a populist, you don't think in check and balances. They are instrument by the corrupt elite to screw up the people, basically. And it's so the thing that the populists go to power, they don't implement any specific economic policy. What they do is to disable all check and balances, which is the difference between democracy and illiberal democracy. So sometimes people mistakenly say, oh, there are elections, so must be a democracy. No, the election is not just election. A democracy is not just election. It's together with check and balances. It's judiciary, independent judiciary system, independent press, and so on. And crucially for us, independent economic institution, independent central bank, independent judiciary system, which controls the contracts and so on. So this is the reason why I think they are wrong, because even though there is no clear economic ideology attached to this, there is a clear implication for economics. We know that institutions are very important. So this informs our empirical strategy to look first what happens when populists go in power, what happens to institutions, to third parties, check and balances, and second to see in the longer term what is the effect on economic effect. Because we know if you break the check and balances in the long term, you are economically worse off. This has important lessons also for Europe, because we do see some populists. We do, and maybe economically they are doing okay, but we know that in the long term they could be worse off. Second implication is that if you have a supranational institution like EU, which is holding in the institution despite the populists can do less damage, so to speak. 10 minutes, okay, let's go to the minutes. This actually, a big problem with populism is how to define populism, as you saw yesterday. It's a little bit like overvaluation for macroeconomists. Everybody knows what is a macro overvaluation, but it's very difficult to define it. I was told that censors have the same problem to define pornography. Everybody knows, but it's very hard to describe and to decide which movie is passable or not. So how do we describe what is a populist or not? Well, given the definitions they have, which is based on a narrative, political scientists go back to the narrative. So what they do is to take the original speech by populists and classify them according if they are populist or not. This is contrast with two approaches economists follow. One is Rudy Dorbush and Sebastian Edwards, who basically decide who is a populist, which is like a censor decide what is good or not, but just like this, which is an approach, but of course it is very bad. The second approach, which is more sophisticated, but much more critical to me, is to have LLM and to look how many times you are named populist. I think there is a problem with that approach. And the approach is that given that populism has a negative connotation for many people, sometimes it's used improperly like a derogative term, not in a technical term. So, he's a populist. But it doesn't mean, so, and of course there is a feedback because populists don't do well economically, so they are called populist ex post, and there is a huge problem of identification. We want to avoid this. So we take not only a definition from political scientists, but the source on the narrative of what they do. So there is a big project organized by Professor Kirk Hawkins, who teaches political economy and is a guru of populism in Latin America in Utah University. And they look at the speeches of all leaders and they check for specific wording, suggesting the ideology I was pushing before, that the world is divided into two groups, antagonistic, and there is nothing. So no check and balances. And this is a question they look, they have a bunch of students, and they look at the 6 categories. They look anti-establishment rhetoric, so the people against the elite, the us versus them, dualistic view of society, which is crucial, no check and balances, appeal to common people, so very emotional talk to the people. So no nuances, no central bank independence, no other things. The people decide, and simple language, emotional approach, and direct engagement. All these characteristics are independent from economy, are the narrative of the populist, of the leaders themselves. So they go through several speeches, manifesto, and speeches at the beginning of the government, and they look for them and they score them. And between 0 and 2, and very populistic, less populistic, and so on. So again, the key issue here is that in this rhetoric, there is nothing about economics, but a lot about institution, how to treat institution, how to disable check and balance. And this has big effect on economics. Well, this is just an example, but I jump because otherwise we don't have much time. So the logic we have in mind is the following. You have a populist leader, which comes for other reason, which disable check and balances, and this in turn has an effect on economic outcome. Now, if a part of check and balances are useful to enforce a budget constraint, if you disable them, you hit a budget constraint sooner than you hit debt and debt crisis and so on. But however, if you have manna from sky, if you have terms of favorable shocks, you can last longer, you can disable them even more. So logically, populists disable check and balances. Check and balances are important to check budget constraint before the crisis. If you have commodity boom, you don't hit the budget constraint sooner, but sooner or later you have big economic effect. So this is a logical scheme that we follow. So let's do, we start, our sample is Latin American country for the reason that Alejandro was mentioning. We consider 20, and we can do this mostly for Latin America because the focus of Professor Hawkins is on Latin America, so we cannot put other. If you put other, we run into the problem of tautological definition of populism. We have some democratic indicators, which are the things that populists are not very happy about. They want to disable because they go against the logic of us against them. And we check standard macro variable, and we control for terms of trade, just to check this hypothesis that you have extra life if you have 5 minutes. 5 minutes to talk about a populist. Okay, we use standard local projections, and where we control for populism, commodity shock, and fixed effect, country fixed effect, time fixed effect. So we really control for a lot of stuff. And here, and we do a lot of robustness tests, and I can show. And here's what happened when you have a populist in power. So here's comparing to populist versus non-populist. In all, in the first few years, you have immediately a deterioration of institutional variables. You have a democratic accountability goes down. You take out all any check and balance. You have business freedom also decreases. And this is actually, this is very important, is left and right populist. Because what happens that in the classification, people give, oh, if you are right populist, at least you are good for the economy. No, it's this is damages both, the institutional damage in both cases. Because in both cases, for their own purpose, they disable check and balances. And here is, we put various variables under various dimensions, and the message is consistent. As I said, we are controlling for country fixed effect and time fixed effect. And so this is comparing the populist and the populist leader against populist people without country without populist leader. And here is, I present the economic effect of populist leaders. And here there are two things to share. First, that it takes time. So the effect is not immediate. If you contrast this institutional, you have immediately this effect on institutions. And here on economics, you find a little bit a delay issue. The other thing, which is a cycle which was highlighted by Rudy, is that Rudy Dorbush, was that the role of a real exchange rate. In many Latin American countries, the exchange rate plays a key role. But if you don't have the good institution, you run into fiscal problems. Because there is the inconsistency, which is well known to macroeconomists. And the populist is a fantastic case, because you have a fixed exchange rate. At the same time, you run inconsistent fiscal policy, as we show. So over time, you accumulate inconsistency. And the case studies show how to paraphrase Tolstoy, there are many inconsistent policies. Each one is inconsistent in its own way. So this is the case study. But the overall picture is quite clear. Now we do a bunch of robustness tests, but using alternative threshold, alternative definitions. As I said, I like our definition because it's taken there and it's logically consistent, but we are very democratic and we accept other definitions. We have a Democrat commodity exporters only, left wing. There was a co-author who was very keen on showing that left-wing populists were particularly bad. He couldn't find it. And I'm happy about this because it shows that the issue is this check and balances more than the...
How do you call it?
Sorry?
How do you call it left-wing?
Left-wing. Well, Hawkins gives a definition. So it has things, and on top they codify also some left-wing redistribution and other issues. One minute. So caveats. Okay, their measurement challenges remain, but I think we are doing better than other, and our results are robust using other indices. And the mechanism, I think it's pretty clear, but I think we need to do even more about this mechanism. How populism, just to repeat, populist leaders weaken institutions, populist leaders associated with macroeconomic imbalance in the long term. The macro imbalances are due to the fact that they disable check and balances. And the commodity booms prolong the life. We use check and both as an explanatory value and as an instrument, and the results don't change much. The problem that it's a weak instrument, so we don't have it. And the long term, and populism is very insidious because the short run, especially if the external conditions are good, or you have the European Union, or it's good, but this eroding of institution is what is the problem, and that is pretty strong in our results. Thank you. Ah, no, the picture.
Very nice. Okay, all right, great. So first discussant, Elias.
Perfect. So thanks a lot, Şebnem, for your kind invitation. It's a real pleasure to discuss this paper, which came just a week before I started my block week teaching on emerging markets, where we discussed issues like that. So it was actually very good for me to refresh, my understanding of what's happening in Latin America. It's also, I get it as a privilege that a Greek is being asked to connect to this feature of Latin American populism. Our former Prime Minister with Evo Morales, both classified as populist in those widely used proxies. Let me further say that I really look as a non-Latin American. That's the dream final for us among two countries whose leaders are also classified as populist, although the one being very different to another. I'll come to that shortly. So let me start with trying to place this paper in kind of a big picture. So Latin America, correct me, I have here the most distinguished, I guess, Latin American economists. So that's how I teach Latin American to MBA students. You read the news, there's going to be a crisis. Argentina, Venezuela, some form of a crisis. Many defaults. Let me just show you some kind of statistics. The biggest 5 defaults in history, although now Greece holds the gold medal in this fantastic ranking. Recurrent defaults, Argentina, Ecuador, Venezuela. Actually, Turkey has just 8 defaults, being at par with Argentina. But also what those crises tend to mask is these efficiency gaps. Latin America was a place where many Europeans used to flock for opportunity. This is not the case anymore. You can look at aggregate statistics. There seems to be some form of a structural break, I don't know, late 60s, early 70s, perhaps related to Peronist policies, perhaps related to external developments. And I think what is kind of interesting, at least to a non-Latin American, is that you read the news, at least this was my youth in Greece, you focus on a particular crisis, you see Argentinian presidents living with helicopters, but in the end, the story is that of long-run decay. So we have 2 interrelated, I would say, kind of challenges, inefficiencies and crises, and then we have politics. And we can think about Latin American populism as a way of dealing with these chronic deficiencies, what quite often result in hyperinflations, in balance of payment crisis, in banking crisis, you name it. Now, which way causation goes is pretty hard. And if you read, and I read again, the Dornbusch-Edwards collection of case studies and the recent paper by Sebastian Edwards, they kind of make this populist cycle, which effectively tells you, look, this is kind of an equilibrium that is self-sustained. What are the driving forces? Typically, the literature will not address that literature that deals more with balance of payment kind of dynamics. But there is a kind of another literature which I mainly have been working, which says, look, you have some long-run, perhaps, driving forces of inefficiencies, both economic, social, and political. There is a famous conjecture by 2 prominent economic historians, Stan Engerman and Ken Sokolov, that said, look, the mode of the colonial economy, very high land inequality, mineral wealth, bringing slaves for Africa. You have some Spanish or Italian or European kind of local elites, and this mode of production kind of persists. You can add an Acemoglu, Johnson, Robinson kind of twist that those elites that were initiating the decolonization maintain de facto political and economic power, and then we have institutional inertia that explain this feature. I'll come back later on these issues. So 2 issues. So this comes from a paper of Francesco Caselli, which I think is very interesting. I teach it to students, saying effectively that, look, Latin America, very large efficiency gaps. Even if you reach the level of education, human capital quality, ICT and infrastructure that one observes in the US, Latin America will go something from an income per worker of around 1/3 to something like 1/2. So the rest half is TFP's efficiency, which perhaps relates two issues that you are discussing in this paper. So how can we think now about this paper and a couple of others on this kind of journey? So in a nutshell, I mean, Antonio did a very good job presenting the regression analysis. Populists won in power in this kind of a recent sample. They tend to spend a lot. Sometimes they are lucky, like Nestor and Christina. They have a windfall, they kind of spend it. Things work, but in the end, we have economic malfunctioning and, most importantly, institutional degradation, although there, as Antonio concluded, there has to be a bit more work here to make this point much more concrete and succinct. Now, there is a companion paper by Funke et al. At the American Economic Review trying to do like a more systematic analysis going back to the turn of the century. They employ an ad hoc measure of populism that will come shortly, and they also tend to find in a before-after, if you like, framework, look, when a populist comes in power, so think about, I don't know, the Kirchners or Peron in these kind of classifications, things economically do not pay off. Also, they have some results in the very end showing that inequality doesn't move much, although the data is not particularly strong. So don't think about an inequality efficiency kind of trade-off, at least on economic efficiency. They also have some results on Latin America. So this is left wing and right wing, but they also have some results in Latin America, effectively showing that once Latin America looks similar to the rest of the world, perhaps the right wing populists are kind of more prudent, although even this will change in subsequent results they have in the paper. So I have two sets of comments, one which are like more geeky or more positioning this kind of paper to this big literature on populism, but let me start with definitions. I had to add, obviously everything started with the Greeks, so let's not get confused here, the Turks or the Chileans in the room, okay? So there is the Socratic method that you first need to define terms. Actually, there was one of the Stoics at Distance who was actually a competitor of Socrates, who said, look, so here, that's why I put here the Greek, just because Antonio also speaks Greek. Well, wisdom, Sophia, starts, let's look at names. So let's try to look at names, see what are the commonalities of those names, and perhaps this can help us, generalize. In some sense, a bit like economics. You take like case studies, and then you try to write a good model. So, who are the populists? Well, I think most people will say that Juan Perón, Eva Perón, and let's not forget, Isabel Perón was also VP and briefly the president of the country. So I like Argentina because you have tango, you have romantic relationships even at the very top. This is the wisdom of Perón. He's writing a letter, I think, to the Chilean president telling him, forget what economists are telling you. Forget, all the wisdom in this room. When people ask, give them. They ask for more, give them more, forget the constraints. So in some sense, that's a very contemporary view also to think about fiscal profligacy and kind of inappropriate fiscal policy. We have Vargas, let me not go. What I really like in Argentina, you maintain this relationship of couples. So, hopefully in the future, we'll see more couples in the president. We have also in Nicaragua now, I think Daniel Ortega's wife is about to take over, or effectively, she's already in power. So let me go now to definitions. So there have been three approaches so far. The one which, let me call it economics, because two prominent economists came up, which defines populism in some sense as part of macro. So I don't know, Ricardo or Jaume, it's macro, there is a section, fiscal policy, you can use this definition. It doesn't have any politics, you downplay the fiscal deficit financing. John Cochrane would love this definition. Now, there is a modern definition, since Antonio discussed that, which although they argue it doesn't have economics, actually does, I think, because it is this antagonism. So the modern definition is that let's take this room, we are all heterogeneous. What a populist does is that say, look, you have the pure people and a bunch of corrupt elites. There is anti-institutional because the elites against the pure people, obviously we have to go with the pure people. Institutions, as Antonio pointed out, serve the interest of the elites. And then there's kind of another definition by two American political scientists, which is kind of long and hence perhaps more accurate, that places authoritarianism at the core. So I'll come to that shortly. So how do we measure? One approach, let me start with the approach that the authors take, is that you take speeches, you classify them, you use humans, now you can use LLMs. According to those, Hugo Chavez is the gold medalist, Nicolás Maduro is the second in command, Evo Morales is the bronze, Erdogan just missed the bronze medal. According to that, Angela and Tony are the least populist politicians according to the approach that the authors effectively kind of use. Let's go over speeches, what is the intent? With Sergey and many others, actually, you can also go to party manifestos, which are not so great because there's like a lot of nitty-gritty kind of stuff within the similar picture. And that's the paper at the AAR that the authors and I kind of mentioned before. What is kind of interesting is that in the 50s, 60s, and 70s, most of populism is classified as left, reflecting Latin America and the likes of Perón. The surge in the recent period is almost half and half, with people like Bolsonaro, at least in the classifications, appearing way more, if you like, relatively to people like Lula. So some early thoughts. So the populist leaders are pretty good at dividing society, finding perhaps some differences, magnifying them, making them more solid. I'm afraid that economists, we are falling to the same trap. It's really hard to come up with a 0-1 classification. And moreover, I think we are imposing our own prior. Someone writes a model, I understand the logic of the model, but excessive fiscal deficit is kind of not particularly beneficial. It leads to inflation. Inflation is detrimental to the economy, is especially harmful for the poor. But having a classification based on fiscal policy would have been way better to have like fiscal populism, or another word. Now, my second remark is that what exactly is orthodox and what exactly is heterodox? My understanding is that in the mid-80s, when the Washington Consensus was exported to the rest of the world, capital controls was considered to be heterodox. Industrial policy was considered to be heterodox. My understanding now is that industrial policy is not considered anymore heterodox. In some cases it failed, like in Africa. In some other cases, like in East Asia, it kind of worked. So I think we need to be a bit more humble on that. Let me give two concrete examples, coming actually one from my personal life, one coming from my professional life in South Africa. In this classification, I had to really push as a referee to take out the African National Congress, which was considered either Mbeki and Mandela as a populist party. Why? Because it spent on the indigenous African community after the end of apartheid. Well, a casual reading of the modern history of South Africa, not to say what happened in the transitions, 1990, 1994, and I was telling this to the authors, and Pierre Olivier handled it as the editor. In some sense, the ANC is the least populist party in the world. Many people were saying, take the property of the whites that have been exploiting you for centuries, and actually the implicit deal between Frederick de Klerk and Nelson Mandela was not to do that. So why are we classifying someone as populist? Simply because you try with fiscal policy to help a chronic problem. Going to the Socialist Party in Greece, I'm a bit biased here because my father served in the cabinet, it's classified as populist, and on that I did not insist to the authors because I didn't want to impose my strong prior here. Why? Because there was an anti-American jargon. Is being anti-American after a military dictatorship, that is after effectively a weakly institutionalized regime for half a century, where in order to get prime minister, you had to go through the embassy of America to get appointed as prime minister? Is this considered a populist? I'm not sure. We can debate about that. Which brings me to the first, I think, conceptual, be more specific, the subversion of democracy and how this affects our classification of populism. So this is a famous example, at least to me. So you see the chief of the military police, a dude named Montesino under Fujimori's Peru. Fujimori was democratically elected. I think he was not, he was in some sense fiscally conservative, but he killed some people in the very beginning, and then he established like a system where the Supreme Court judges will give a receipt to the chief of the military police that they received the bribe, and they would be on video. Okay, so here, the classifications that the authors and many others use will say Fujimori is a populist, but actually Fujimori is most likely an authoritarian, especially in the second term, which is another kind of point I want to make here, is that there are very big differences of first and second term. At the review, I published a great paper, I think, by Vincent Pons, showing even in democracies, the second term of the people we vote for tend to be worse economically vis-a-vis the first, which I think is something important here. And again, I had to bring the old Greek hat here. In some sense, I think what we are confusing two things with populism. One is that what Aristotle called, you had a corrupt version of a political system and a good, with ochlocracy and politia, if you like, democracy, or ochlocracy being the vintages of democracy, the good and the bad, but also we have like an oligarchy or a tyranny. So here we are somewhere in between, and we need to define things much more properly. Now, there is a work, this is my job market paper when I did my PhD in the Neolithic age, when I hung out with Aristotle, that's how I know what he was preaching, showing that democracy, on average, tend to be associated with a boost of economic performance. Daron and co-authors did better, non-parametric, every complex technique you can think of, something similar. And most importantly, when we have autocratic reversals, things deteriorate. This is based on a 0-1. So this would be, I don't know, Chile under, before Pinochet, under Allende. Under Pinochet, it's going to be an autocratic reversal. So perhaps we need to better connect these two genres of the literature on democracy, non-democracy, and authoritarian populism, non-authoritarian populism. So concretely, I think what the authors can do, starting with this point on democracy, autocracy, we need way more work. This is not a control. We need to delve more into those understandings. There was also a question yesterday looking on Argentina. Now, on the data front, what I would say is that it is clearly a limitation of the paper, that it starts in 1970. There are data issues here, so it's not the author's fault. But I think now we can use some form of an LLM. You have a training sample, what the political scientists have done. Perhaps we can go back in time. And I would say also contrast intent with actions is very interesting. I remember Andres came to my class saying that most likely he was spot on that Boric portrays to himself to be coming from the far left. Most likely he will rule reasonably. When I gave a presentation on this work, the finance minister of the Tsipras II administration was there, and he raised his hand, George Kouliarachis, and said, look, we are the opposite of populist. I understand that we said we will spend a lot when we take power, but after Varoufakis stepped down, Greece under Syriza ran fiscal surpluses of 4% of GDP, which ex ante I would have thought is impossible. So I think we need to be a bit more kind of careful here. And I would say also that perhaps, and this is perhaps spending too much time on business schools, perhaps we learn more from the case studies, or perhaps, I don't know, also since the journal now tries to publish different sets of views, perhaps you start with the case studies, elaborate on them, have the before-after perhaps with some synthetic controls, and then try to take stock on what are the homogeneous parts, the commonalities, and what are the heterogeneities. Thanks a lot.
Okay, our second discussant, Jaume.
These are not my slides. These are my slides. Well, first of all, thanks for inviting me here to discuss a paper on this actually really nice paper on a topic I know little about, but perhaps the fact that I know little about would allow me to take a step back in some of the discussion of what is going on of the paper. First, I think that this is a very interesting topic, and this is a fantastic team to deal with it, given their experience and knowledge, but they restrict themselves. They don't use their lots of knowledge about policy making and trying to extract conclusions based on rigorous economic analysis, and that I appreciate a lot. The first thing is a research question: what are the institutional and economic consequences of populist leaders in Latin America? Let me say that yesterday we had a discussion whether it was leaders, governments, or regimes. Here is everything about leaders. All the variables measure characteristics of leaders. Everything is about the tenure of those leaders. So it's personal, okay? So it's about what these leaders do. The second, the research methodology, cross-country comparisons between the performance of those governments which they catalog as populists and those that they are non-populists. So the comparisons will be between those that make it to the list and those that don't make them to the list. That's what makes them different. And this is where we have to find the reasons or the mechanisms or the theories that suggest why the behavior is different. And I want to be very precise about that. The technology is great. They use local projection methods and they do a collection of robustness analysis. And I'm not going to discuss a lot about the technical aspects of the methodology for various reasons, among them that I would not be the most knowledgeable guy to do that. That's one of the things. And then the research conclusion is that populist leaders weaken institutions and worsen macroeconomic outcomes. So if you have these guys that we're going to catalog them as populist, they do that. Overall, I think this is an excellent and rigorous paper that provides a lot of new and useful information, but it can be improved. And that's what I'm going to focus on. And part of what it can be improved is that it can be perhaps reorganized a little bit, because some of the things come on the right time, some of the things come in the later time, and we want to think about that. So I'm going to start by saying, what is a populist? And I'm not going to be philosophical, or I'm not going to be trying to understand what this concept is. For me, always being a populist is if I call you populist, it's like an insult. So if you are a leader and somebody says, this guy is a populist, it seems like you're a liar or you're promising things that are impossible or something of that sort. But actually, we want to make it a little bit technical. We want to do what the definitions are, and I'm going to show you a little bit what is it that makes somebody populist here. Okay, so I'm not going to go to there's a big philosophical concept like populism, like if it were other concepts like truth, like whatever. I mean, not in that case. I'm going to say they're going to make comparisons of 40 countries over a 55 period. Some of these countries are going to go with a label that says I'm a populist, and some of them will not. And whatever we find will be the difference in behavior between those that have the label and those that do not. So what qualifies for you to have that label? I'm not going to talk about Dorbush and Edwards, Funke et al., because it has already been discussed a couple of times. I'm going to talk about the Hawkins Index, which puts together a bunch of political scientists and asks them to rate speeches from leaders. And they give them points. And if you got a lot of points, you are very populist. If you don't get points, you are not populist. The first complaint I have, a little complaint, is that this is shown to me in page 17 of a paper that has 22 pages. And the first 17 pages of the paper, I am dancing and I don't know what populism is or what it does. And then I see this thing in a corner of the paper, and then I say, let me forget about the history of the world, let me forget about philosophy. These are the countries we're going to be analyzing, and we're going to see whether countries that have this feature are different than others. I would start with that, and then tell us, using this criterion, I find that these are the countries. And then the very nice discussion about the waves of populism and so on, you can say this methodology actually identifies something that many of us would have thought if we had been a Rudy Dorbush, we would have said this, and this, and we would have nailed the countries, but it's ex post validation. I wouldn't start with that. That would be kind of the first. Now, when I think about what makes me a populist, the first two items, anti-establishment rhetoric and us versus them mentality, suggest that these are leaders that are operating in a context where there is change and conflict, as opposed to situations where there is less change and less conflict. So I want to know, whatever we see that is different, we have to attribute it to the fact that something new is going on. They just got elected and they are changing things that have been operating for a long time. Or alternatively, because there is a conflict situation in the country. So these are two factors that I would already think when I'm writing a model. When I see this, I say, what kind of model will I write about this, why they are different? These are two things that strike me. The third one is appeal to the common people, which is kind of a class struggle. Typically, you will go with the poorer people. So I would say, I would start thinking capital and labor. The capitalists are scared. Something bad is going to happen to them. Labor are happy. Something good is going to happen to theirs. So that's what the kind of conclusions I would look from those countries. Now, the last three ones, emotional appeal, simple language, direct engagement, they are all about being an effective communicator. Ronald Reagan was a great communicator, somebody mentioned yesterday. Bill Clinton was a great communicator. I don't know, really, that's what we want to do. So one of the things I would like you to tell us is what are the weights of these items? Now we know what these political scientists are asked to do. I would like to know what are the weights of these items. And could you change those weights and think whether the different effects are coming because I'm a good communicator, whether there's a lot of class struggle, or there is change, or there is conflict. Could you change the items and examine exactly what are the features? Now, once you know what these guys are guys that operate in a process of change, conflict, class struggle, and they are good communicators. Why would they behave differently than other leaders? What would be the outcomes different when you are leaders that are operating in this type of context? Now they do have a series of facts that I'm going to put them here. That's the facts that they come. And one of the other things I would say is when you identify these particular channels, perhaps you could have a discussion about the theory or the sort of setups that would deliver these facts. The first two facts are not about what I'm just talking about. The recent wave of populist leaders enjoyed unprecedented favorable terms of trade. You just check it and that's right. And they last longer than other populist regimes in the past that didn't have that. But I would like to know whether favorable terms of trade enable populists to last longer compared to those that are non-populists. That you never do in your analysis. Or because it could well be that the good external conditions are good for everybody, and perhaps even less so for populists. I'm not sure. I don't know. But the discussion of that would be. But now we go to the facts 3, 4, and 5. Think about change, conflict, class struggle. Populist governments favor strong fiscal expansion. That sounds very natural to me. So that's one thing I would really like to check, and they do check. Populist governments are associated with real exchange rate appreciation and external current account deterioration. That I'm not 100% sure why it should be. That if I am in a conflict, I would have an exchange rate appreciation or so on, but I've seen already in previous sessions that what determines appreciations and depreciations, it's still a very difficult question to ask. But I don't see really why one would expect that unless you had already a prior of some past experiences or whatever, but a priori, given my definition, and given the theory that I could bring to bear in this issue, I don't know whether I could write this down so quickly. And populist regimes are associated with weaker institutions. We're going to see all of that in a second. But before that, I was wondering, what would you write on top of that? What other facts would be useful to check, given the sort of sample that we have and the type of comparisons that we are making? And I said, populist leaders are associated with a reduction in investment and capital flows. Well, if there is class struggle, the most likely thing is that domestic capitalists take their money to Miami or Panama or wherever they can. They don't invest in the country. Foreign firms might not want to come. There should be less investment and there should be less capital flows. That's not going to be the case, but it would seem to me that that would be the kind of natural outcome in a model that introduces these elements. Populist leaders are ineffective at implementing their policies initially, but if they remain in power long enough, they improve their effectiveness. Now, why would I think about this fact? Well, when there is change and conflict, the government takes over, but the state has a lot of institutions that are not the executive. There are courts, there are civil servants that have entered they have some loyalties, there are social institutions, there are a lot of institutions in the country that are still from the other part, for the establishment. It takes a time to have these people change and to bring the new people everywhere and not only in the executive. The executive is the point, is the point of attack, but the rest of the institutions need to change. So therefore, I would expect that at the very beginning, the entire state makes it difficult for the executive to carry out whatever policy it want to take, because they try to shield against this change. But if they last long enough, perhaps they have a time to change the state, and eventually they would become more effective. So that sounds like a reasonable thing to check, and perhaps you guys can check it in some way. Populist leaders reduce property rights protection initially, but if they remain in power long enough, they might improve it. It's a very similar kind of logic. At the beginning, you want to redistribute to the poor. You want change. A situation of change makes you feel more uncomfortable, makes you feel less, makes you feel more risk, and so on. But eventually, once you settle, actually, that's it. But these two facts that I am suggesting, out of many possible other ones, are based on the fact that being anti-establishment and criticizing being in a conflict is a temporary or transitory thing. I would assume that, for example, Chavez is a populist based on that, but Maduro was not 25 years later. I mean, who was the establishment in Venezuela? You see, it's not that the establishment was still the old regime back in the 90s. And populist leaders would worsen the business and financial environment because typically they align with the poorer, which are class workers and so on and so forth. Now I want to think about that would be my first one. Be literal. Be literal on what you are measuring, what your variable does, and use all the discussion that you have as a validation of that particular variable. And don't get into philosophy of things because we're not going to solve here together. We all have great ideas about what populism is in the mind of some. It's different in my mind than in your minds. Now about the effects. Here, I really missed in the paper, and actually during the presentation, Antonio, more discussion of these effects. This is wonderful. The production of this picture is great progress. Now, the discussion of what this picture means, I have my doubts. So I think the paper is very interesting because we have it here. But let's look at this picture. We observe clearly in the first panel there, I don't know whether there's a pointer. No pointer?
With the hand.
Okay. Yes. Oh, you see my hand. The first one on the top, the real exchange rate appreciates. That's fine. That we can see. Although I didn't know it immediately why that would be. Inflation is basically not affected. The fiscal balance worsens after 6 years. The average tenure of these governments that they identify, or these leaders, is about 7 years. It changes a little bit with the sample, but it's 6, 7 years, sometimes 8. That would be the median or the average of these guys. Government revenue grows a little bit. Government expenditure grows. The current account goes into deficit. That is sometimes seen as oh, it's bad or whatever, but that's an ability to borrow. And this borrowing is going to consumption, which is in the panel here. It's going to consumption. private, but it's going to public consumption, it's going to investment, it's going to public investment. These are guys that invest a lot. I don't know whether it's a good thing or a bad thing, but if I look at this, I say exports are not changing, imports are increasing. But the one I can say is that we are allowed to take money into the country and invest. I don't know. Is that the story we have here? I don't see. I'd like to see things like about also, for example, growth of wages relative to growth of output, changes in the share of capital. I would like to see things that relate to this conflict and measures of conflict, for example, direct or things of that sort. Now let's go to institutional results. And I want to say something about what I do about the institutional results. When you take a look at this here, let me start by the one that seems to be moving more is democratic accountability. It's going down, democratic accountability. What is democratic? And I would say, oh, democratic accountability is going down. But then I struggled for a while because you are controlling for democracy. And if you are controlling for democracy, I'm a little bit unsure. What does this make? So that's the first thing that got me a little bit confused. You should think about that. They control for democracy for good reasons, but perhaps in this particular regression, you have to think about it twice. And then I went to this index of democratic accountability and I tried to say, what is it telling me? You see? And you go to this index, and this index means what they are asking this a political scientist again, or somebody that assesses political risk, is to put countries in one of 5 bins. There are 5 bins. The first bin is alternating democracy. This is everything is wonderful, and on top of that, we have seen alternation in power. That's the best. The second is dominated democracy. I don't know really, but everything is wonderful, but we always keep electing some guys for more than 2 terms. We elected. Then the third is de facto one-party state. Elections are held, but the system is designed or distorted. And the fourth and the fifth, I don't even consider it because there's nobody in the sample that is called a populist and is in the fourth and the fifth. So essentially, democratic accountability must mean that Venezuela moves from 1 to 3. It was alternating somehow and then it moves to 3. I really would like to have more discussion of this variable, because if the whole claim of the paper is that it weakens institutions because this particular line turns out to be going negative, I like more texture to that. I like more of a discussion of which are the countries that are going down, why, what category they are moving, what does that mean. Now, when I look at property rights, actually, it seems like very reasonable. There's a little bit of a loss of property rights early on when you have the conflict, when you have the fight with the anti-establishment, and then it goes up. Actually, I think this picture is beautiful. And it will be consistent with a transitory conflict and change of regime and things of that sort if you open yourself up to possible additional facts as the ones that I was mentioning. Then there is the business freedom and the financial freedom. Those go down as I would expect too, but I want to have a little bit more of texture as well. Business freedom is an index based on 4 items. And when I look at them, it's access to electricity, business environment risk, regulatory quality, that's fine, and women's economic inclusion. I'd like to understand a little bit more. Open up the boxes of these indices. Tell us a little bit more. If you can break them down into pieces, see which one is the good one, which one is the one that matters, and so on. I would like you can do so much more, I think, on this account that would make the paper even richer, more useful. Financial freedom, that one has very nice elements, and I would like to see the piece. The one that I am really a little bit baffled, you see, democratic accountability, I told you, property rights works well. Business freedom and financial freedom, it's something that I would have expected, and I'm not surprised, and I think it's good that it found government spending is real weird. Let me just put it. I didn't know. This is unlike, if you look at the previous thing, government expenditure is going up like this. But if you look at this here, government spending is going down, and you ask why. This government spending is an index that is kind of 100 minus a coefficient types the share of GDP to an exponent. So that if you hit 57%, you have no government spending. If you are above 57% or below 57%, then you have government spending. I don't know what that means. Some political scientists decided that this 57, or whatever the coefficients tell you, is the optimal thing for spending, and that if you do more or you do less, then it's going to create you trouble. No, I don't buy that, and I would drop this picture and this variable from the paper right now. Then the government effectiveness, we see that the government is becoming less effective, and it doesn't seem to be recovering. That I think it's an interesting result. The variable makes substantial sense to me. So these two were just to support my claim because my memory could go away on what these indices were. So I want to go back to the very beginning. I enjoyed this paper very much. This paper has very nice output. It has a very clean definition of what populism is. You might agree or not, but it's conflict, change, class struggle. The good communication part, I would leave it aside. I would try to clean up from that, because there are situations in which you don't have these items and people communicate well or not. And then it gives you some sharp results on what is happening. So we have, and the methodology is good. I am not fair with them, but they do a bunch of robustness tests, and they look at different samples and so on. And they have a good discussion that I interpret about country cases that they put you now in the appendix. I liked it in the paper too. And a discussion of these three waves that I would use as a validation for the things that you pick. The research conclusions, I don't agree with all of them by looking at the pictures, but let's have this. And I enjoyed very much this paper. I really enjoyed, and I think that it's a very good contribution. Thank you.
Okay, we are going to get questions now, but let me clarify that we have to be a little bit like efficient on time. So let's get the questions. Maybe you can answer something very urgent and then keep talking to people during our walk, because we have to walk to lunch and we have to come back here because we are moving the panel from 2 to 1:45. So we are going to start actually 1:45, not at 2, so that we can finish at 3. So having said that, so please be efficient on your questions. Linda.
Okay, I'll be efficient.
Okay.
So we have two papers that look at populism and their effect on government spending, inflation, economic outcomes. And at least my impression is they get different answers. So this paper finds an inflationary impact that's sort of nothing at the beginning, and then it kicks in after 6 years or something. The other paper found it on impact and pretty strong. Fiscal balance takes a long time, again, in this paper to kick in. Other paper found it right away. Left and right doesn't matter in this paper. It was a key finding of the previous paper. So I know it's like different samples, different populism definition. It's a different time period, but it would be really nice to know, especially given that there's an overlapping author who has access to both data sets, to tell us if you used the definition of the other paper, or if you had used the sample. You're not going to be able to do everything, but to at least try to reconcile how it is, because you like to come away with, even before we get to all of the, add additional, just the basic facts. Is there a connection between populism measured in some way and these economic outcomes?
Okay, so yeah.
So I guess I'm getting obsessed with the European Union, but because the title of your paper is Lesson from Populism, what are what should we expect from the wave of populism rising in Europe now? Next year, there is the French presidential election. The two leaders in the polls are both will be classified as populists, one from the left, one from the right.
I'll be very brief because I want to talk about this later by 5 minutes. But at the risk of getting stuck with definitions, there's always. Oh, sorry. Thanks. Elias told us that definitions are everything according to the Greeks, and I'm going to agree with him. So bear with me and let's stick with definitions for a minute. I think the political scientists are very right in one sense. We economists, beginning with Rudy and Sebastian, were being completely tautological. We define a populist if he or she pursues populist policies, and that's just not very helpful. So the political scientists go off and say, well, that's not quite right. Populism is about politics, it's about a certain style of politics, Mure and Rovira Kalbalzer, et cetera, and that's fine. And that's mostly what your guy from Brigham Young is doing. But there's a risk in that. And the risk is that, and both discussants sort of hinted at this, but I want to underscore it. The risk is that what follows in terms of actions from that rhetoric can be very, very different. That is to say, you can get people who came to power with fairly aggressive rhetoric because the previous situation was very nasty, but that rhetoric does not translate itself into changing institutions and weakening checks and balances. And I can think of examples. Sorry if I cite two examples from my own little country. We had a very far left president for the past 4 years who had completely incendiary rhetoric when he came into power, and he governed like a Democrat. I didn't vote for the guy, I didn't particularly like him, but I will recognize that he was incredibly scrupulous when it came to democratic accountability. Today, Chile has a far-right guy, didn't vote for him either, who came in with very nasty rhetoric from the other side. And it looks like he's going to be very democratic as well. So what am I getting at? I think you need to do, when you do your coding, some sort of a robustness check in which the starting point is, yes, I think that the people are good and the elites are bad and the foreigners are terrible, but then there must be some follow-through, and I think the follow-through must be something having to do with democratic weakening or erosion of institutions. Because if, you kind of gave us the first line of what the political scientists say, but there's a second line which you didn't cite. They typically say, if I believe that there's a good people and a bad set of guys, maybe the elites, maybe the foreigners, it follows that not all political views are equally legitimate. Because if the people speak, of course, what they say is legitimate. If, the evil elite speaks, what they say is not legitimate. And once you question the legitimacy of different political views, out goes pluralism. And once you get rid of pluralism, you get rid of all the other stuff. Checks and balances, freedom of speech, and so you need that as a constituent sort of part of the definition, because otherwise the rhetoric can just really lead you astray. I mean, I'm happy that you begin with the rhetoric, but I think you cannot stop there. And to some extent, what both Jaume and Elias said, I think went in that direction as well.
Tarek.
So let me put a slightly finer, maybe pig-headed point on this. So I would say, in fact, definitions are nothing, and the source of the identifying variation is everything. So I think that in some sense, the most credible exercise you have here is uses a variation that comes from the value of the natural resources contained in the country, right? So it comes from world market shocks to that. And there's a long literature that basically says that, that's, so these shocks affect a bunch of stuff, including how populist I sound today, but also my GDP and a number of other things. So in some sense, I think you should think of this more in reduced form in terms of like what happens as a result of resource shocks. So I think maybe the most pig-headed and orthodox view that view of this. There's another Asimoglu Johnson Robinson paper that people typically don't read. I think it's in the JME. They have this like beautiful point that they make is that essentially the frequency of macroeconomic crises that you run into is basically completely unrelated to the policies that you adopt once you control for institutional quality. So, you know, in some sense, if you believe that result, then it follows that what you say about economic policy should also not matter. I'm not sure I believe that result, but that's, I think, what the orthodox view is.
Yeah, I just wanted to say that I found particularly important and interesting the articulation between populism and autocracy and authoritarianism. And I would really welcome a kind of, I don't know, expansion, deep dive into what are, I don't know if it's the interaction between populism and institution or if it is certain types of populism, but something that would tell us more about what are the populists that go into, you know, democratic undermining in a serious way and authoritarianism, and the others that don't, if that exists. And I think it's really important also for the current environment.
Ricardo.
Very small points, both related to Andres' claims about Boric in Elias' class and now. I think that there is another dimension of populism that is, you know, we tend to think in economics, at least these are people that are very good winning elections, controlling for their quality, you know, and fundamentals. And I think that's the case of Boric in Chile. I mean, had he been competent, he would have done enormous damage to the institutions of Chile. So there's a second dimension, which is very important here, is competency. And sometimes competency works the right way. This time it helped Chile enormously, the fact that he wasn't competent. And I think the Rudy and Sebastian view was more of the other way around. These are people that, you know, win elections, but they don't understand general equilibrium, they don't understand budget constraints, and blah, 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 blah. And that's what damages the country. And so it would be good that you separate, I think, between the ideology part and that part, which is what is it of the populist that is important for economics? And that sense, I worry a little bit about the definition by political scientists because they're about lots of things that we economists don't care particularly about. We care about bad economic decisions. That's what you're really after. So
we also care about the institutional rules that govern your decisions, right?
Absolutely. But those are two layers, different frequency type questions, by the way. Yeah.
Okay, great. Let's start walking to lunch. Is there something you have to say, must, but just one thing, because you cannot answer all these questions, so.
Okay, I would say, I think Andres' point is extremely relevant and pointing towards that maybe now we're shifting to the other side. I mean, maybe the political scientists are biasing their definition towards democratic backsliding and institutional decay. And it's implicit in how they do it, because if you delegitimize your opponent, then you justify democratic backsliding. So maybe we should mention that, because we destroy Rudy and Sebastian, I think maybe too much, because they were just showing how they do these things, and that was, I think, their important contribution. And then we're implicitly praising these other guys that maybe are falling to a similar trap in their definition.
So we'll continue the conversation, and then this whole topic is going to come back anyway. So let's, Arno, are you here?
Can I have one little word?
Yes.
Just to Linda. The exercises are different in that one looks at the past populists and the effects of monetary policy today, and the other focuses only on the current policies, which many of them did not have inflation targeting rules. And what we did about samples is we rerun the exercises that Antonio and Alejandro with the Funked data. Yes, and we use it continuously, and that's also and with different percentiles to look at the most. Because if you use it continuously, on the one hand, you are including the. I mean, they have a little bit of populism, but in the end, that's why they may have some discourse, but they don't deliver. And so they take we take to the most extreme, and more importantly, because the index goes from 0 to 2, but 2 is not the double of 1. So, right, that doesn't mean you're really, it's more cardinal than it's more ordinal than cardinal. So, but we ran all those exercises and the results did not change.
Okay, but there's a lot of detail there that needs to be unpacked. All right, thank you very much again for coming. I am extremely happy, and we are all very, very privileged having this very distinguished panel here today with us. Ricardo Caballero, Andres Velasco, Mario Obstfeld, and Helen Ray. So how I would like to do this is I'm going to just put out some, kind of not questions, but the things that I would like to learn in this panel. And then I will give each 5 minutes or so to, talk about those or anything, the panelists, they do want to talk about. And, I can ask more questions. We can come back. We can take questions from you. So this is basically going to be a free-flowing panel. And now we have the music. I mean, that is the last thing.
Tropical music to go for the theme
All right.
of populism.
Yes, apparently there's a wedding outside, and then, yes, exactly. All right, okay, let's start. So,
but I would say I prefer the windows open and the music. No, but leave it open. Yeah.
Yes, okay, great. So it's going to be then live the panel. We have our music, and we have, great, very distinguished panelists. They're all experts on these things. So let's start. Okay, couple things that I would like to get out of this panel is, first and foremost, we all know that globalization lifts billions out of poverty, but distribution effects at home helped fuel a populist turn, right? This wasn't only a United States thing. This happened in other countries too. One of the things I would like to learn from the panel is, as a profession, what did we miss? And at this point we are at right now, at this juncture, is the protectionism the only answer out there? If there are other credible alternatives, let us discuss. That's one of the things I would like to really learn more about. The other thing is, of course, learn from emerging markets. There are experts here who knows a lot about emerging markets and what emerging markets can teach us in terms of fiscal populism. Is fiscal populism can be helpful in certain cases, or very damaging always? Is it always political, or is it sometimes a response to rationally binding constraint? Is another thing I would like to know more about. Another thing that we should be talking about is financial fragmentation. We told a lot about trade fragmentation in the last 2 days, but of course, if this is the world now we are going to be living in, a protectionist world, at some point, we will see also financial fragmentation that goes with it. What are the implications of that on global financial cycles, smaller economies, on policymakers? And finally, in generally, what is going on with the markets, right? Are the financial markets still trustworthy in the sense that they will turn a blind eye to politics and what is going on and they do their job? Or will they act as amplifiers and putting more fire on the problem? So these are some of the things that I'm curious about. I'm sure there are more you are curious about. So why don't we start with Mario?
Thank you, Şebnem. It's great questions. I think my general take on the sins of economists is we have many sins, but globalization is probably not the biggest sin. How we manage it is an issue, and that's more of a sin we might share with the policymakers who we didn't advise effectively enough. I view the ills associated with globalization, the ills associated with the global financial crisis, as causes of discontent that are taken advantage of by populists. And I think it's important to keep in mind what is really going on when we see these populist takeovers. There was a great book a couple of years ago by Anne Applebaum called Twilight of Democracy. And she, I think very insightfully points out that populist uprisings are not about the common people rising up against the elites and throwing them out. It's about a would-be elite who is able to mobilize popular discontent to take over from an existing elite and perhaps change institutions and embed themselves in power over the longer term. And I think this explains a lot about what we've seen historically and what we see now. And this theme is there. Goes way back in American history. You could view the American Revolution as a struggle between two elites. A very influential elite that wanted independence, including people like Thomas Jefferson and George Washington, against the loyalist elite who is imposing the institutions of the British Crown. And we won't go over the history, even though it's 250th anniversary. But you could say that had some elements of populist revolt. Once the new elite takes over, they change institutions. Also, their policies are also often devised to keep them in power by changing the political structure of society. So a great example of this, which is not right-wing populism necessarily, but is more related to the paper we heard on Latin America, is given by Albert Hirschman in a very famous paper from 1968 on import substituting industrialization. And what he points out is that import substituting industrialization limits imports. It creates a dependent class of domestic producers who are substituting for imports. By Lerner symmetry, it discourages exports, and it prevents exporters who might be able to push for better policies from becoming a very influential and powerful class in society. And so it serves multiple goals. In the US, tariffs are presented as a way of righting certain historical wrongs, grievances with the international trade system. But if successful in reviving manufacturing, it also creates a class of people who could give political support to the current regime. We often ask about how it is that Republicans could so quickly abandon their free market principles and embrace Trumpism. I think what we've seen is that those principles were not really central. The Republican Party was a vehicle that could be hijacked by an outgroup which long felt excluded from the commanding heights of society, whether those be the intellectual world, the scientific world, the world of universities. And these are not like poor working class people. These are people often educated in places like MIT and Yale and Harvard that are now being eviscerated or attempted to be eviscerated by the Trump administration. But they are people who have a different agenda than the prevailing culture, and have felt that the existing democratic institutions didn't really provide them with enough of a means to contest leadership, given the overwhelming sway of liberal ideas throughout society in the United States. And so, what we're seeing is an all-out attack on those institutions, which is much worse in the second Trump administration than it was in the first Trump administration, because in the first Trump administration, many of the sort of established elites remained in positions of power, even inside the government, inside the civil service, and we're just seeing an evisceration of those, and it's being supported by another elite, which is the tech elite, which has decided that the Trump administration's goals are very consistent with what they are trying to do. So, let's not think of populism as necessarily, addressing these grievances trade policy is addressing these grievances so much as serving the interests of the new elite that takes over.
Thank you, Maury. So now, Helen?
Thought you were going to go with Andres.
Oh, sorry, yes, I'm sorry, yes, it's Andres, yes, it's Andres, yes. It is like this, yeah, left, right, yeah.
Whatever you say.
Yes, Andres.
Brilliant, thank you very much. Şebnem invited us to a high-level panel, and that has two possible interpretations. First one, people are very high level, which they are. Secondly, one can speak from a very high level and speculate. And that's exactly what I am going to do. So take what follows not as some well-identified causal claim, but more as a provocation. That's what you get to do when you have enough gray hair in your head. So, the narrative which is very much out there, including in bits like economics conferences, is that populism is really connected to economic failure. Whether it's inequality, real wages, hollowing out of the middle class, job losses, etc., people are pissed off. Because this happens in a democratic context, people are also upset with democracy. The standard phrase is democracy is failing to deliver. And as a result, well, we get populists. And we get populists of the left sometimes, we get populists of the right some other times, but basically they are reacting, or they are the answer to this popular frustration, which has its roots in a failure of delivery. And typically for the US, where this case is most often constructed, you get things like that. Gini coefficient in the US went up in the 90s and then sort of has moved around, but arguably kept rising. Parenthetically, it's not clear why something that happened 3 decades ago has an impact on politics today, but that's a different question. But this is the kind of picture people show you. People show you this kind of picture, which is from the famous author et al. China shop picture. Not only did you have the hollowing out of the middle class, but that was geographically concentrated. So those red bits are the bits where you had job losses as a result of Chinese imports. And there's some correlation between the red bits and the places which, vote for populists, the left behind regions, etc., etc. And if you look at the US, in Europe, support for democracy seems to be falling, but in the US, the support for democracy seems to be falling even more. So again, I'm not being scientific here, I'm just sort of illustrating a narrative which I think is quite well settled. Some people on the left emphasize the inequality a bit more. Some people on the right emphasize the sort of low growth, frustration of a middle class bit, but ultimately there's a claim about economic failure leading to democratic failure, leading to populism. I don't know whether that claim is statistically right for the US. Elias knows a lot more about this, and there are 255 papers, and many people have made the claim that yes, you can probably make some causal statements along those lines. But I want to invite this very international, global, and sophisticated audience to think as to whether this claim is generalizable. And my hunch, and I'm going to give you some very loose data here, my hunch is that it is not really that generalizable. That is to say, a lot of the debate has been excessively influenced by events in the US. To some extent also in the UK, but I actually, if you look at the Gini in the UK went up with Thatcher and has been falling ever since. So it's, if it's not true for the US, it's even less true for the UK. But so, the debate has been North Atlantic, and, we all tend to repeat the North Atlantic debate. And I think this is not quite right. And let me tell you why. First of all, and this is going to be really armchair econometrics, so please forgive me, you can find plenty of examples of countries which elected populists even though the economy had been growing pretty quickly. And there's some citizens from some of those countries in the audience, so I'm sure they can pick a little, it's an issue of timing, when did he come to power? But, Turkey was a pretty strong performer, right? Poland is an amazing performer, right? Since 1990, the country that has grown most in the world is China. Number 2 is Poland. Poles in PPP terms today have the purchasing power of the Japanese per capita. And nonetheless, Poles are furious. They elected a populist president, and it's pretty likely that in the next election they will also elect a populist prime minister. Philippines, same thing. Secondly, is it inequality? Well, maybe it's inequality, but it's quite striking that you have very strong increases in declared support for far-right parties in places which are very egalitarian, including pretty much every country in Northern Europe and France, right? And yes, we can have a discussion of whether these far-right populists would or would not address inequality. Maybe they would do so via protection, whatever. But typically, and this is my third point, if you think the problem is inequality, well, I vote for the left. And the elephant in the room is that the big surge in populism in the world has been on the right. We Latin Americans don't get enough credit for having invented populism, damn it. But our kind, until recently, was mostly on the left. In the rest of the world today, it is mostly on the right. So if it were on equality, I'd expect Jeremy Corbyn to be sitting at number 10. He's not. Mélenchon should have won or should be about to win the French election. Bernie Sanders should be in the White House, etc. And it doesn't seem to happen. So at a very high level of generality, this story doesn't quite fit the facts of how populists get to power. The other bit, which is much more related to what we heard about in the previous panel, is that when populists get to power, they typically make a hash of things. They make a hash of things economically, and they make a hash of things institutionally, right? They weaken checks and balances, put their cronies in the judiciary, do away with all kinds of guarantees for citizens, do away with competition authorities, close the statistical agency, blah, 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 blah. Nonetheless, and I think this is a big puzzle, they keep winning elections. It is true that by the third or fourth re-election, it's not entirely free. They have tweaked the rules. But the first and the second time, they actually win because they're popular. Even though often they've made a mess of things, and even though every single time they have actually reduced the political power of the people voting for them. And I think this is a paradox that we social scientists need to think about. Why do I vote for a guy who's pretty clearly going to reduce my political power? Yes, eventually maybe they get kicked out. It happened to Orban in Hungary. But, Modi in India, I mean, I'm not an expert in India, but being at the LSE, I go to India a lot because my best students come from India. And, it's quite striking the degree to which Indian democracy has been weakened massively by a man who's been in power for 12 years, and he seems likely to be, in power for 12 more. And the opposition, the Congress party, has been eviscerated. So why do Indians keep voting for this guy? On economic performance, the story is mixed. Yes, the economy has grown, income distribution has worsened. He really bungled demonetization. Regionally, there's a lot of inequality. Nonetheless, people seem to love Modi. Mexico, we were talking about Mexico over lunch. Yes, it is true that the wage share of income went up under AMLO, but everything else went completely wrong under AMLO. Terrible government, skyrocketing crime rate. He couldn't run, but he picked, his successor, and she got 62% in the first round, which nobody had ever gotten in Mexican history. So, the story that it's all about economics, and if you deliver, people vote for you, and if you don't deliver, people don't vote for you. I'm sure there's a lot more serious analysis. I'm not doing serious analysis, but I think we need to reframe the question. So, let me suggest now that what I'm saying is not entirely at variance with academic research, because there are people thinking about these subjects, but they're not in our little corner of the woods. So the delivery model of politics I described already, but it's really a model of politics which is very much influenced by economics. I have some preferences. I'm an unemployed worker who lost his job in the steel industry in Gary, Indiana. So I go around and I decide what the right policies are, a tariff on steel. Then I go around shopping for a politician who will deliver a policy that I like, and then I vote for that person or that party, okay? There's a whole school of political science research which will tell you that this model of politics is simply wrong, conceptually wrong and also empirically wrong. And if you want a reading suggestion, people have been citing certain political scientists. I'm going to cite my favorite two Princeton guys, Chris Aikenreich, I'm not sure how you pronounce his name, and Larry Bartels, who wrote a book called Democracy for Realists, which came out 10 years ago, Princeton University Press. And what these guys, the book can be summarized in those two quotes. They say, voters, even the most informed of voters, typically make choices on the basis of who they are, their social identities. Once they have their social identities all in place, and they've decided that they support the Democrats or the Republicans or this party or that party, then they decide what they think, what policies I prefer and what policies I advocate. So the arrow of causality, which in our model goes from policies to preferences and voting, in this case goes from identity and preferences eventually to policies. But it really works the other way around. If you have ever run for office, which I have, this sounds absolutely right. You're on a street corner handing out leaflets, people talk to you when they do, which is very seldom. Politicians nobody likes, and they want to talk about your dog or your children or which football team you like. And once you've established a relationship of trust, they say, oh, by the way, where do you stand on pension reform? But it's really an afterthought. It is not that they came to talk to you because you actually believe in that. So the implication of the identity model of politics for populism is very, very different. It says, what you do first is you identify, so you have a political movement or a candidate who establishes identification with a group of voters. And once that identification and that trust has been established, then you talk about policies. And if this sounds too far-fetched, let me remind you of one extraordinary fact. Donald Trump celebrated his 80th birthday in the White House lawn a week ago, and what did he do? Did he have people perform the great works of American classical music? Did he bring poets laureates? No. He had UFC. He had, what's it called in American?
UFC.
Exactly. Large, beefy guys trying to, whack each other in the head. Why is this politically very wise? Because it tells that guy who lost his job in Gary, Indiana, hey, I know that I promised jobs in the steel industry. I didn't deliver, but I'm one of you anyway. Keep voting for me. And it is pretty true, I think, that Trump 1 did not deliver any benefits for that guy in Gary, Indiana. Nonetheless, that guy in Gary, Indiana voted for him. And so did people in Michigan and in Wisconsin and in Pennsylvania. He carried every single pivotal state. So the question, I think, for liberal Democrats on the center right, on the center left, is whether we can play that game. And that game is very hard to play if the guy playing the game is Trudeau, whose dad was prime minister. And it's very hard to play if you're Macron, whose money was made as an investment banker and you went to l'ENA. And it's very hard to play if you're Rahul Gandhi, whose father, grandmother, and great-grandfather were all prime ministers, right? Pretty hard to identify with somebody who was 3 prime ministers as direct predecessors. So I am not claiming that this explains everything, but I am suggesting that there are political scientists out there who have a radically different approach to the subject, and I at least find it somewhat revealing. Thank you very much.
Thank you. Good.
That was really high level.
Thank you very much, and let me really thank Şebnem for great organization of a conference. We're all absolutely grateful to you, Şebnem, and for asking me to talk. And here I'm going to take you up on fragmentation, financial fragmentation, because that's what I know more about. And after talking about and it's always difficult, so I have to find a topic on which I can say something. But it struck me that we talked a lot about populism this morning and economic outcomes, populism and democracy, and we had very interesting papers to discuss about all that. But there's another dimension maybe that will probably be directly related to what I'm going to talk about, which is how about populism and external policies, kind of confrontation, nationalism. That's also conflictual attitude, lack of cooperative attitude. I mean, that's also something that I associate. Now, I don't know with which definition of populism, but I think it's also very interesting. So in that spirit, I'm going to be discussing fragmentation and cryptocurrencies. And the reason also I'm going to be talking about that is that we might be entering a new kind of phase in monetary history, in the sense that we have gone through a greatly integrated world under the gold standard, and Maury has done fascinating work about that, and then Bretton Woods, etc., with well-functioning world order, to fiat money world with dollar dominance and the key role for the US Treasury market, to maybe we're entering a new phase. I mean, it's hypothetical again, but we do see new technologies, and these new technologies, I'm talking about tokenization of money and cryptocurrencies, might actually be introducing new means to do protectionism and fragmentation. So in what, how would that work? Well, so let's discuss that. So what are the crypto instruments that exist currently? So we have a bunch of things which are like the native tokens. I'm not going to be talking about those, Bitcoin, Ether, etc., because they are indeed tools which have been associated with libertarians very much. However, nobody, I think, thinks that they can really scale up and become really very important in the international monetary system. It's just too costly. A fully decentralized system is very costly. In the case of Bitcoin, which is still the biggest market cap in those categories, just simply too costly, both from an energy point of view, but also real cost, but also simply a transaction cost point of view. So these things I'm going to dismiss. However, we also see stablecoins emerging, and in particular there we have two US dollar stablecoins which are really a duopoly. They constitute maybe 98% of the total market, Tether and Circle, Tether being the most important one. And we are also maybe seeing, to some extent a little bit, the possibility of tokenized deposit coming into being, though it's relatively limited for the moment. Okay, so now how does this kind of new framework maybe can lead to fragmentation and actually to some extent conflictual relationships? Well, here I want to talk, and again, Maury talked about Hirschman, and Hirschman is obviously this amazing thinker because he has really foreshadowed a lot of the important topics of the days. And he has introduced the idea of power and trade and choke points. And so one of the very important choke points that we have in global networks is the financial choke points. And the fact that the US dollar has been, or the US dollar system has been really very, very difficult to go around in the world economy. So what is a choke point? It's a situation in which you have very high concentration, you have asymmetric dependence, and what you have is hard to substitute. So that gives you leverage, that gives you coercion, that gives you sanction power, essentially. So I think we can all see that the dollar payment rails really fits all these characteristics, and that really the payment systems in dollar are really a very powerful instrument in international finance. Now, however, and so I'm just going to here show you very briefly some, this is the data about the US dollar stablecoins. As you can see, there is a lot of stablecoins, but there are only two that matters and for the moment, and it's Tether, USDT, and it's Circle. They constitute most of the capitalization, and as you might know, Tether is actually located in El Salvador, and Circle is regulated mostly in the US, also a little bit in Europe. So all the market cap is essentially almost for the moment in those instruments. Now, because the US payment system has been a choke point, it has been used for sanctions, right? And so that's the so-called weaponization of the dollar. But this weaponization of the dollar has been evidently quite potent in the past. I mean, we know about the Russian sanctions, we know about Iran, etc. But it has also led to a number of countries to seek for alternatives. This is where the fragmentation theme is going on. So this more confrontational attitude has led to a scramble for alternatives. And so what are alternatives in payment? So that means trying to fragment the payment system in order not to go through the dollar to avoid the sanctions. right? So avoid the choke points. And so here I'm just showing some current data from chain analysis crypto crime, which shows that in the recent period, we see a much bigger rise of cryptocurrency value received by illicit addresses, mostly the yellow graph here. This is sanctioned entity. So we see that sanctioned entities are finding ways of going around the traditional dollar payments by either using different currencies or using different instruments, such as cryptocurrencies here. And one thing that we know is that there's very fast growing Russian token ruble stablecoin, for example, in the recent period. We also have North Korea, we also have Iran, and we also know that for the very liquid stablecoins such as Tether, the more liquid you are, the better the ability to kind of hide illicit transactions, right? So this provides this technological shift, is also, which by the way has been largely also pushed by the United States in terms of a stable coin. We know that there's a full backing of the US Treasury, for example, and the White House is also switching the system towards the possibility of more fragmentation in that very system that was very dollar-based, and therefore that could enable very, very potent sanctions. So in a way, there's a bit of a paradox here, because the payment rails in dollar have been weaponized, and because of the push of US dollar stablecoins, which push these new technologies which are more decentralized, incentives of other countries of building alternatives have been growing. So there are competing crypto and payment systems which are being developed as we speak, and that is in turn via the fragmentation is kind of creating, if you want, protected areas from the dollar system, which are fragmenting, at least in part, payments worldwide. All right, so therefore, I think what we are seeing, and I think this is connected also to populism, but again, this is a link that was not clearly discussed or established, and I think this is something to look into. That populism and geopolitics, more confrontational approaches, are actually on the rise. And it does seem that, at least for payment systems, the geopolitical alignment and alliances matter a lot. So you don't hook up your payment system to geopolitical rivals, right? There's a matter of trust, which is very important in those matters, and trust is very low. And populist government, it seems to me at least, play very much on mistrust instead of trust. So I think there is a clear link towards the two concepts. So geopolitics seems to matter more for payments. There's a recent working paper at the ECB, which even kind of estimates that you are 3 times less likely to hook up your payments between geopolitically distant countries. I also think that there's going to be fragmentation, possibly, of payments for other reasons, which may be more technological, which have to do with the technology themselves and how safe they are. Again, question of trust and cybersecurity, which in the world also of geopolitical conflicts is a very, very rising risk. And therefore, if we think about the various scenarios for the monetary system, I think there's a scenario which is about more dollar dominance, and that would come about because of more crypto dollarization, because of the US dollar stablecoin entrenching somehow the financial infrastructure in US dollar, because the large US banks might have a comparative advantage in tokenized deposits to some extent. So there's a possibility here, and that would not be more fragmented, but that would be a different types of financial system. But there's also another possibility, which would be this fragmentation that I was describing, linked to this more conflictual approach and to this delinking of payment system because of mistrust, okay, and because of sovereignty issues. And on the one hand, that would be for Europe, and for a bunch of other countries to avoid being taken hostage by sanctions. Right. So if I just finish here. I think this kind of rising geopolitical rivalries, to some extent I connect it to populism, leads to a number of interventions that we have discussed in this conference, such as tariffs, such as export controls, such as more FDI screening, etc., which lead to fragmentation both on the trade side, also on the financial side. And if we have a rerouting of financial flows, as we have of trade flows, we have more of this block constituting, and therefore we have also a shift in interest and alignment among the, so certainly a breakdown on multilateral cooperation, and this reinforces geopolitical rivalry. We stop here. Thank you.
Ricardo.
Okay, thank you, Şebnem, for this great conference. I almost didn't feel the heat. Maybe we'll feel it now. I understood my mandate as essentially talking about the role that markets could play in amplifying one of the big consequences of populism, which is enormous amount of debt in the system. With that mandate in mind, I was very inclined to use my Latin American hat, talk about risk off and all these kind of things. But I already used my Latin American hat yesterday, so today I want to do the opposite. I want to use my US hat, American hat, which from the point of view of these thoughts, means that I'm going to think about the problem of having too much debt issued by a country that in which is very unlikely to default. Okay, so solvency is not an issue. And if you think about what is the role of debt, I'm going to think about a very simple model in which you have only consumers and a government. Those make up aggregate demand. If you think about what in a standard non-Ricardian model debt does, it creates wealth. So you have more wealth, that leads to more consumption, more aggregate demand. And against that is, if you think about the steady states, you created more debt, the government needs to service that debt. That means primary deficits have to be, a little lower in the future. And so whether this extra debt expands aggregate demand or not, it depends on whether the marginal propensity to consume out of debt is higher, of the wealth created by debt, is higher or lower than the interest rate. And in almost any Ricardian model, that inequality is possible. Okay, and so that's why you get classical sort of result is, think of Blanchard models and the like, you put more public debt, you're going to get more aggregate demand. Now, if aggregate supply doesn't respond to that, then you get an equilibrium interest rate which goes up. And so that's a typical consequence. And then you can start thinking about that kind of implication. Well, what if you have higher interest rate and you also have investment, that may be crowding an investment. Those are the traditional effects. The point I want to make is a little different. And it's the point of contact with the mandate you gave me, which is really the production of safe debt is not really something that a solvent government does by itself. It also is a production process that also uses the financial system. The ability to roll over debt, for example, is a service that the financial system provides. It's not the household, it's the financial system. And the capacity to warehouse debt or the risk associated to that, to roll over that debt, to participate in primary markets, in secondary markets and the like, or to facilitate transactions, that's all a service that is provided by the financial system and that uses resources and so on. So the question I want to ask is, what happens when I enrich the basic model and I think about this extra service that the financial system needs to provide in order to produce the safe debt that ultimately our household collateral users want? Okay, and that's what I was thinking about. This is very recent, so fertilization happened a month ago, so this is a very early stage of gestation. I end up with a paper that is very suggestive of that, this safe debt Laffer curve, and that's what I want to talk about today. What is the idea here? It's very simple. There is first an increasing section, which is a traditional, expansionary effect of more public debt. You create more wealth, and that's a phase in which you increase aggregate demand, if potential output is given, you're also going to get increased interest rate. But the more debt you have, the more strain you have on the financial system. You know, it's more costly it becomes to really roll over that debt and so on and so forth. So the more resources it consumes. And that translates into a series of spreads, you know, basis trades and so on are all about those spreads. The term premium starts to changing and so on and so forth. So if you think about the steady states, eventually, you know, when you add debt and you increase the marginal cost of producing debt, you're also changing the cost of rolling over the entire stock of debt. Okay, so as debt starts rising, you start generating a very big drag on the system because you start generating a lot of spreads that apply to larger and larger stocks of debt, and that becomes very burdensome on the financial system. And at some point, that inequality, that burden overwhelms the wealth effect that you get from in the standard model, and then you get the downward sloping section. So at that point, so my definition of Laffer curve is not in terms of how much debt the country can produce. The country can produce an enormous amount of safe debt, but the cost of the whole system of making it safe becomes very costly, and it becomes a drag on aggregate demand rather than an expansion on aggregate demand. And so that Laffer curve is in the space of aggregate demand. There is a certain level of debt to financial system capacity at which the effect on aggregate demand is contractionary rather than expansionary. And for the same reason, if you think about the model, you know, general equilibrium, then what will happen at that point, the safe interest rate actually starts declining because you're getting, why is it that, I mean, ultimately the government has to pay these things through spreads and the like. So at some point, the contraction that you're generating in the primary deficit in a steady state is larger than the private expansion in aggregate demand that comes from the extra debt. That's what gives you that downward sloping curve, okay? But at that point, you know, you have insufficient aggregate demand, then what you need is lower interest rates. So the other forms of wealth can boost aggregate demand. In this particular little model is human wealth goes up, and therefore that restores equilibrium. But you get this downward, this shape as a result of that. So, and this is really preliminary, a week old. So the question is, where is the US now? Okay, so if I think in terms of this model, where is the US now? And essentially here what I do is I combine data on size of balance sheet, changes in the basis trade spread, changes in the term premium and so on. And I try to do a sort of natural experiment around a big expansion in public debt, which, you know, COVID is a very nice natural experiment for that. Put it all together, and when you come up with that picture on the right-hand side, which says, look, and here's Helene's convenience yield, and all that was part of the when we had, you know, public debt at the level of 60% to GDP of 60% or so. And you can see that the expansionary effect of more public debt was very clearly positive, like 500 basis points. So marginal progressive consumer out of safe debt was much higher than the equilibrium interest rate. The policy rate, real policy rate, was much higher. You had like 500 basis points of a spread there. That began to decline as public debt rose. And today, this is a very conservative approach. We have very little space. So this suggests, this very early calculation suggests that the US is very close to that peak in terms of aggregate demand. What is this about? This is a story of indebted demand. It's just saying, look, the government decides to borrow a lot today, then if you're solvent, at some point you'll have to repay. But since all these spreads, because your financial system has are going up so much, you're going to have to contract your primary deficit a lot in the future. And so that's what I was saying. So I want to, that's my bottom line, but I want to finish with a parting thought here, which is what we're seeing here today. That's the story of the US. Think of the US in isolation. But the financial system, as Helene well knows and has communicated extensively and very lucidly to all of us, is very integrated. No? It's a big thing. And we're seeing this problem everywhere. And on top of that, so what you're likely to see, you know, is as the US continues to expand, that's going to really squeeze emerging markets. So there I wear my emerging market type hat. That's going to be big headache for the. In fact, in the US today, we're seeing a reverse crowding out problem, which is massive amount of investment grade corporate issuance at this moment is larger than the US Treasury issuance. You know, is beginning to also squeeze the treasury market. So the peak of that Laffer curve, which I think, we're very close to that peak, is even shifting to the left. And so I think we're going to turn rather quickly in a space of a steady state, rather quickly means 5 years or so, into sort of having a massive drag from all these issues of public debt.
Thank you. All right, very nice. So we heard from amazingly knowledgeable 4 people here and on really interesting stuff. And we have 20 minutes left. So in the interest of time, I'm going to open up to questions from you. Please put your name tag. So
can I just ask a question to
of
Ricardo?
Course, yes.
So Ricardo, in that spirit of the rollover cost, etc., do you see the U.S. Treasury initiative of U.S. dollar stablecoin as one way of decreasing the rollover cost by increasing possibly the net demand of U.S. Treasury, which was one of the justification of Secretary Bessent?
But I don't know how that helps. I mean, rollover risk, one way of attenuating rollover risk is by having a lot of inelastic demand, okay? Yes. And that helps a lot. And so the more inelastic demand you have, the rollover risk starts later. And if the rollover risk starts later, then the peak of the Laffer curve shifts to the right. By how much we can do out of a stable coin, I'm not so sure. I think it's, we're talking about $40 trillion of debt versus $1.5 trillion. I don't know. So that's the numbers may not square.
But do you also feel that financial repression or things like that are the type of thing that you're thinking about to decrease the rollover cost, or is it? Do you connect to that?
Well, I wanted to start under the assumption that's when I say I want to wear my US hat, which now is not the same quality of hat I must admit a few years back, in which all these things that we are very used to think about are not likely to happen. And what the perspective shows is that even under that scenario, you have that kind of situation. Now you start adding other kind of things, then you start shifting things even more. But this is from the very sort of sanitized perspective of the problem.
Marie.
Just a very quick one to try to integrate what Andres and I said with what Ellen and Ricardo said. I think the connecting point is that the financial markets and participants are often viewed as elites and targets for public outrage in many contexts. After the 2008 crisis, one of the things that fueled the belief in a corrupt elite is that nobody went to jail in the U.S. So, I guess my 2 questions are, one, it's not really a question, but, if you think about crypto, in some sense, crypto is the ultimate anti-elite project. Yes. It's like we're gonna move everything out from the financial system and do it ourselves, and it will be crowdsourced and, done by the people. And it's, that's really what it's about. And if we, the stable coins, if you move out of the banking system, similar set of issues. In terms of what Ricardo was saying, the incursions on the efficiency of the financial markets driven by populist demands could really affect this, the amount of debt-bearing capacity in a negative way. So that's something to worry about.
2 one-liners on that. One is that Ricardo thought he had 2 hats, but really has only 1 hat. They're beginning to look like the same hat, right? One may slightly larger. No, the other one is on this business of elites, which Maury said something at the outset, which I didn't pick up on, which is, I think, really important. Way too much of this debate has been influenced, Darren and Jim wrote some really amazing things, but the focus on the good guys versus the elite is really overdone, I think, because as you pointed out, it's really not the people against the elite, it's really one elite against the other. Right. And I want to connect that to the last thing you said, which is, yes, the crypto guys will say we are the people and you are the bad guys, you're JP Morgan,
But, you know, the crypto guys by now are sitting on trillions of dollars and they're the new elite, right? And therefore, the idea that they're speaking on behalf of the people stretches the imagination.
This is moving chairs, no?
I
have a question for Andres, really. I mean, I'm very sold on the idea of social identity and all that. What I miss is the last step, is why is it that those people that are very successful at developing a social identity also end up doing damage? There's an extra step there. Well, so is there something in the production of being a nice guy that
Well, actually, I'm not sure I would agree with the premise. I mean, I argue that the guys who do damage tend to be the guys who, no, that's not right. I argued that the sources of populism tend to be in identity, but that doesn't mean that you can have identity and necessarily engage in that kind of policy. You know, Barack Obama was pretty good at creating identity, but he didn't do crazy stuff. I mean, you know, you could list a long list of people who are very good at the game of creating identity, but nothing in the identity creation presupposes that you're going to run big deficits or impose tariffs.
And also, identity can be
but
faked.
then it becomes a model of who wins elections, not a model of what is the economic cost of.
But that depends again. I mean, I don't want to get stuck on this issue because we spent much of the morning about it. Depends what you mean by explaining the populist phenomenon. If by definition we're trying to explain why do people do stupid things, then let's not call it populism. Let's call it stupid things. Right?
That's my point. But the question is whether there's a correlation between the two.
Yeah.
Well, that's the question. But let me do one final question before opening up among the four of you. So you mentioned the now corporate debt issuance is rising. Of course, that's tied to the financing of the AI boom, because now AI boom cannot be just financed by the equity markets and the cash flow, and you do need the corporate debt, which goes back to, you know, what Maury is saying in this terms of if now the tech is part of this new elite taking over from the old elite, and if tech is going to be financing themselves with the corporate debt, right? So isn't it then going to come back, and then, you know, when the spreads rise and the premium rise, shooting?
Two things.
Yeah, everybody.
Clarifications of the facts themselves. The issuance of debt is not a result of not being able to fund with equity. The issuance of debt is a result of not being able to fund it with cash flows.
Yes,
they were very rich in cash flows, and now they need it's not enough. But on the contrary, now they're turning to equity. Again.
Yes.
They're so very overvalued shares in this moment of, you know, last minute to issue equity. So there is issuing massive amounts of equity, which takes a little bit of burden away from the debt markets, but there's no doubt that there's a lot of competition for financial capacity.
Yes, exactly.
There's a lot of demand for a store of value in the world.
Yeah.
But there's also an intermediary role there, which I think is becoming very strong.
Okay, great. Questions from the audience. Elias.
Can you grab a microphone?
Yeah, grab a microphone.
Elias is dangerous because he actually knows the data in this area.
Thank you. So I just want to point that could reconcile Andres's paradox, is that there is very exciting work by Stephanie Stancheva and Alberto Alesina before he passed away on perceptions versus reality.
Right.
And actually on inequality and opportunity, there seems to be this interesting result that Americans tend to believe on the American dream and upward mobility, although the data do not support that, while the Europeans are the pessimists, although the evidence suggests much higher mobility. When asked, they say that there is not much mobility. And there is kind of similar evidence. They have another paper at the Review of Economic Studies on immigration, which again kind of explains the paradox, because if you just correlate immigration on populism, you get a negative relationship, because the support for immigration is high in London, and most immigrants come to London, which I think relates to interesting work on social media, which they're not exactly going in this direction, but I think soon they will. Although inequality in the UK or in France has not been on the rise, if you just follow social media, you end up going in a 5-star hotel with your lovely wife and kids, and then they complain because they see the wife of Cristiano Ronaldo going still in a 5-star hotel, but it's like humongous. So I think this creates this distortion between reality and perception, which could perhaps provide a reconciliation of what you said.
Okay, Tarek.
So I have a statement and a question. So the statement relates to exactly this point. So I actually think that there is sort of like a real part to this. You can go and measure in U.S. data when you look at people's job postings and look at like which technologies are mentioned in which job posting. You can measure the age of the technology deployed in different labor markets. So how new are the technologies that I'm using in Boston versus Oshkosh, Wisconsin? And within the US, you can show that the distance, so think of this as time travel. You go from Oshkosh to New York City. The distance in the modal technology used in these two labor markets is now 20 years apart. And we have good reasons to believe that 30 years ago, that was 10 years. So in this sense, the amount of time travel that you do when you go from a rural area to a city in the US has massively increased, which I think maybe contributes to some of this perceived alienation. The question that I have to all of you, which, so I think one way of summarizing what, we are struggling with is that, a big thing that we learned from economics is that openness is not zero sum, but typically positive sum. And we're now fighting this narrative where everybody seems to agree on both sides of the political spectrum that everything is zero sum. And I feel like that is what do we do to educate the public about this general lesson?
Who wants to take this question?
I'll give it a go. Right. I mean, I'm not sure I have answers, but I have related thoughts. One thing that connects both of the comments we just heard is that we need to explain not only what, we also need to explain why now, right? Because somebody could have said in response to what I said, well, yeah, identity, but we've been identity driven since we were around, in the fields hunting for woolly mammoths. So the hard question is, what is it about the last 20 years that has triggered these identitarian feelings and made them so nasty? And maybe technology, fast technological change is one of them. Maybe social media is one of them. Maybe the acceleration in migration in some countries, not all, is one of them. But I think there's a lot. There's a lot. On openness and zero sum, yes, of course, it's positive sum if you do redistribution, which Maury hinted at hasn't really been done in a country like the US. But I want to go back to my point of the US versus the world. Americans really dislike free trade, we are told today, to some extent, do some Europeans. The rest of the world does not. And this is, international trade theory 101. It's called Stoper-Samuelson. If you join the world and if you're labor abundant, the income distribution, in fact, turns in favor of labor. So, the Brazilians and the Indians and South Africans, may be pissed off about a lot of things, but you don't see people campaigning for tariffs. So, this is very narrowly a US phenomenon with bits of Europe thrown in, but it's really not a universal phenomenon.
Any other? Yeah, Helen?
Yeah, no, I agree with that. We are, however, seeing this new phenomenon, which was not in our traditional trade model, which has these choke point issues. So the actual endogenous formation of network with a view to either extract rents or in counteracting the expectation that other people are going to be weaponizing some type of input or some type of payment system that they may have. So if we are in such an equilibrium, it kind of becomes maybe rational if you expect that you are going to be under threat. It's a bit in a balance of power here. You are also going to have to construct your counter leverage, or to be more resilient by being a coalition of people with whom you can diversify that risk. And I think that's what we are seeing in certain sectors. I'm not saying this applies broadly to the macroeconomy, but I'm saying that certainly seems to apply to the sector of payments, to the sector of critical minerals, to the sector of rare earths. We have seen chips, and we see energy, and we might see more.
Okay, Basilia.
One kind of comment to follow Andres and Ricardo discussion. So in Hungary, in Peter Mayer, one of the characteristics of his campaign it was very much a grassroots campaign. He kind of visit all of like a small region of Hungary, especially the ones that were against him. And turns out that, you know, people in Hungary that have looked into that, like whenever he was visiting a village, actually this village, his performance and his scoring in this village was pretty good. So in a sense, you know, he might be classified as a populist according to the definition we saw this morning, but he's also a guy that kind of played this identity politics thing without necessarily kind of the ambition to destroy the system.
Right.
And so let me do like two cheap comments. And so this China shock has been used, this map everywhere, but this is like diff and diff estimates. So the red part are the part that growing less than the yellow part. And you know, in absolute term, I don't know, but because nobody knows, right? It's not very identified, but in absolute term, they're still better off, kind of, than they were before. So that's kind of the first cheap point. The second cheap point is for Elias.
We are all redoing the China shock paper.
No, yeah. Everyone should. And the cheap point is for Elias. So crypto, you say market capitalization of like the first pillar of crypto is like $1,300 billion. That's about 40% of French GDP. You know, I like to think that France is the greatest country in the world. It certainly is in many dimensions, but not in terms of GDP. So this is kind of small. As the size of the market. Right?
That's what I said.
Okay.
Okay, Tommaso, maybe the final question.
I thank you. This was really great and interesting. It was a comment that I also had before when we had this discussion on what is the definition of populism, and I think Andres is getting this right. So I'm wondering whether it makes any sense to try and think of what defines a populist. So there was an approach here saying, oh, populist is what populist says, for example, right? But I think this is ill-guided. I think that we should all acknowledge that there is an underlying fundamental structural state, which is this fracture between the people and the elite, however you want to divide the elite. I remember a great editorial on The Guardian a few years ago on why did we stop trusting the elite, right? So this is the phenomenon. Of course, given this state of fracture, right, politicians self-select endogenously into looking populists. So I think that the populism is truly endogenous, and how you speak as a populist, the type of phraseology, the rhetoric is completely endogenous to this state, which is, again, why do people have stopped trusting elites? And as economists, we should maybe think more, or even political scientists, where does this fracture come from? Is it the global financial crisis? Is this the unkept promise of globalization, and so on? Populism is just an almost obvious endogenous result to this state of affairs. So I don't know. I guess this connects to identity politics a lot, because you know, politicians self-select into talking identity politics, of course. Yeah.
Can I say something? But I keep going back to my point, which is I buy that as well. But what is the connection between that and bad policies? What is? I mean, that's what we need to do, or either some theory or something. Well, but that requires some development.
But bad policies also come after a point, right? It can be that. I mean, Erdogan is a very good example here. It was all good policies.
I'm trusting the evidence. I don't know. The evidence that these guys do bad things. So
assuming it's a correlation, and not causation.
Let me give them the benefit of that.
Okay, but then
so why is it that having to solve these structural issues lead to bad economic outcomes? Is this because of the particular flirtatious nature of the politician, or is it because of?
But it does go to what Maria and Helen is saying, right? If it is the power struggle, if it is about, you know, between two elites, and now it is played at a world scene. Now it is like, you know, between countries, right? You know, this whole economic leverage and power.
That's creative destruction. It's like, you know, right, is it Schumpeterian or not?
But it is. You want to keep the power, and if it is always about like keeping the power, you are going to, you know, resort to bad policies. Yeah. This way or that way. I mean, it goes back to the endogeneity point. I don't know. What do you think, Andres?
I mean, it's a good question. I'm not sure I have the definitive answer or anything like it, but I would say a lot of what we call good policies are predicated on something like cooperation. Not cooperation in the sense that we all hold hands together and go home, but in the sense that, you know, we abide by certain rules and we keep our promises, whatever. If you come to office telling the world that half or, you know, more of the people in your country are evil because they're immigrants, well, cooperation, collaboration, and sticking to the rules is not going to be the natural thing to do, right? Because you have already decided that some of the people are not worth respecting.
That's a mechanism worth testing.
Yeah, exactly. That's why I'm saying it's just a conjecture, but that's the sort of thing that we should be thinking about.
All right, great. Very, very short because we have to, you know, come to a close right now. So first of all, please join me with a big applause. Like, you know, thank you, our panelists. And let me also thank, of course, CEPR, CECIFO, and Sciences Po, who are the owners of the economic policy papers on European and global issues. And of course, in particular, Anil Shamshadi here at the back, you know, who basically organized everything. From CEPR, Taya Ephraim and Bao Khan Lee, also they are there. Taya is somewhere here. And from CECIFO, they're outside. You've seen them, Karin Foriner and Francois Fogli. So we thank all of them, you know, made our lives great under this heat and wedding music and, you know, boat problems and all sorts of things, like, you know. So thank you so much for everyone organizing, helping lodges and coming. Thank you. This shows like it is a great panel. The discussion is still going. Yeah.